Good morning, everybody. Could anybody hear me?
Yes, I can hear you now.
Thank you.
Good morning.
Good morning, everybody.
Good morning.
I hope you guys are well today.
At least I'm fine.
Wonderful. That's wonderful. I see you survived another week of work, responsibilities, homework, etc., etc. That's good. That's good. Any questions with the homework, or was that definitely the easiest bit of all this semester? Nothing pressing.
No, nothing. Only it appears that some of the roles were overlapping.
Yes. Yes.
Okay, this one. Okay.
If you found that some of them were overlapping, you were on the right track because
Okay.
there were a couple that were overlapping, and I'm happy you recognize that. It means that you went through the whole process if you saw that, and that you understood a couple of interesting things along the way, and that was the idea. Okay, absolutely, absolutely. Okay, good stuff. Um, so today, one thing is certain: time is flying already. When we started and I said we had 14 weeks to do this, I'm thinking, as usual, that seems like a long time. And now suddenly we are into week number what? Anybody knows other than me?
Just about week 10.
Yeah, this is week number 10, which means that you guys should be zoning in, um, reviewing old stuff. Remember, your final exam is not going to be cumulative. It is going to begin with where we left off with chapter. Anybody remembers?
7, 8.
Yeah, chapter 7. Okay, so make sure you have all this down packed so you don't duplicate and miss anything from chapter 7 to wherever we end at the end of week 11. Sorry, 13, which we hope to be chapter 12 on partnerships. Okay, don't forget your final exam is week number 14. Which day is that? Anybody remembers? Wrote it down?
You say May 29th?
May the 29th. Does anybody disagree with that? Okay, wonderful. That means we're on the same page. All right, way to go. Of course, as usual, you can interrupt me at any time about anything, old and new. That's the whole idea with this. Okay. Natasha, are you there?
Morning.
Good morning. Owen, are you there?
Morning, sir.
Morning, morning. Um, well, I remember as I finalize your results, I'm wondering. Some people did okay, well, another person struggled with some of the stuff. Understandably, that's normal. That is not unusual. Okay. Um, if everything was perfect, I would be rather surprised. So I'm thinking about the possibility um, of maybe doing a makeup exam, perhaps. But I haven't made that decision yet. I'll make that decision this weekend, depending on the blah blah blah. So that those who would like and would need to do a makeup exam can do that. I just need to find out if I need to do that at all, given the overall results, and if so, when and under what circumstances. So I'll get back to you on that very shortly. All right, Owen. Ashley,
Good morning.
good morning. Good morning. Akaria,
Curious speaking.
indeed, indeed. Fabienne,
Good morning.
good morning. Cheryl.
Good morning here.
Morning, yes. Irvinette. Irvinette.
Morning.
Morning, good morning. Michelle.
Good morning.
Good morning. Dion.
Good morning.
Oh, darn it, Dion, you're hanging in there. That's what I'm talking.
Yes.
When you get a certain thing and still hanging in there, this crazy stuff, that is to be commended.
Yes.
I know that for sure. Somebody had the audacity, Dion, to ask me the other day if I considered studying law. And I'm like, do I look that young? Thank you very much for the compliment, but I don't think so.
Oh, gosh.
Nothing wrong with that. You can study anything at any age. Don't get me wrong. Just saying. Okay, hang in there. So that's what I'm talking about. Indira. Indy? Okay. I guess Indira will join us shortly. All right. By the way, Dion, just for your information, and for those who think that they're just so young that they're not going to be older soon, this is a story for them. A couple of years ago, I went to do my Series 7 examination. Anybody ever heard about Series 7?
Yes.
Yeah.
Series 7.
Yeah, the Series 7 examination. The examination that you need in the United States if you want to do brokerage work on the exchange, etc., buy and sell securities, that kind of stuff. So I go in there, and this is like quite a few years ago already, but I was already over that number, Dion. So I walk into the Series 7. Most of the Series 7 students are either college grads, they're just out of college, finishing college, and they're 20s and all that. So they give me this look like, he must be an invigilator. He must be works here. And so they were fine with that until I sat in the same booth with them, and they're like, they had that look like, no way, this old guy could not be in here doing this thing with us. And yeah, so not to worry about it, hang in there, don't worry about how folks look at you, what they think. That's not your problem. You do what you're doing. That's the point. All right. Any questions before we go on? All right. So let's get right into chapter. What chapter is that?
9.
What chapter? Chapter 9.
Yes.
Did anybody get to reading chapter 9?
Yes.
Okay. That's good news. Because sometimes getting to read stuff could be a big headache after all day and all the issues at hand. So chapter 9 is really about what?
Receivables.
Yeah, receivables and receivables and cash. And this is a very important chapter, not only in accounting, but is also important for businesses to how put into practice. And it's also important even for individuals. So those of you who are not even accountants or not even responsible for this stuff at work, it is certainly something for your own personal use as well, once you can pull out the important aspects of it. So this particular chapter, like many others, particularly this one, is very important even at the individual level. Okay, I know nobody has any doubt in this group, I'm sure, that cash is the most liquid asset in any company and in any household. Okay, some of you might know already that if you own property and don't have money, property can't pay for a flat tire, correct? Property can't pay the $500 when you go to doctor's hospital to be admitted. You need cash. So cash is the most liquid activity in any organization, and therefore we have to take very good care of it. Cash is also the part of an organization that people have their eyes on, always looking for a way to get some. True or false? Not everybody, just those
True.
people.
True,
Yeah,
true.
okay. Some people, somebody's always looking to get some from somewhere. If you leave the door open, and sometimes even when you have the door shut, they still find a way. They break the door down, sneak in, whatever they have to do, physically or metaphorically, get their hands on cash. Right. So cash is crucial. It is important that people who are of good mind and good ethical background are managing cash, because and cash has not cash management has nothing to do with your degree. It has to do with your ethics. Because most of us, qualified or not, it's all about are we TIFAs or not. And so organizations have to be careful, um, because since most people are not TIFAs, most of us do the right thing. That percentage is always waiting to grab and make the rest of us look bad. All right. So that's the cash side of things. Then we have the receivable side. By now, from earlier transactions and journal entries, you guys should know that, of course, the receivable is any amount owing to the company. And so, even though you may not have cash in hand, if people owe you money, you need to find a way to get it, and you need to find a way to get it as quickly as possible. Because as long as people are holding your money, when I say people, I mean somebody who borrowed money from you personally, somebody whom the company gave credit to. As long as they have your money, you don't have it. And if you don't have it, you're not liquid. If you're not liquid, you can't pay your bills. And what happens when you can't pay your bills, anyone?
Have the collectors calling you.
Yeah. Then you have the collectors calling you.
Bankrupt.
And can you tell the collectors or somebody else is how my money, I'm waiting for it?
You can.
That's not going to help you.
That's not gonna help.
No. When the bank calls for payments, as soon as I get paid, I'll pay you. Will that help? Maybe for a while. But don't be too long. Because after a while, they're coming at you with all doggone hell. Okay? So, yes, cash is crucial, but so are receivables. If you're a company and you're a person and you have bills to pay, you have to collect your money. All of you should know by now, whether you're guilty or not, whether you're the perpetrator or the victim, you should know by now that people do not like to pay money back for some reason unless they have to. And sometimes you have to force them to pay you your own money back. How about that? All right, receivables. Okay, a couple of things before we get into the nitty gritty. Cash management is a very important aspect of any business. And so we start our discussions out with a very interesting concept called compensating balances. Does anybody knows what a compensating balance is in the real world? What is it? Compensating balance. What is it? Oh, never heard about it. Never read it.
Hello?
Didn't see it in that nice fancy new textbook.
It's a minimum amount that a bank requires a company to keep in its bank account as a part of a credit granting arrangement.
Yes. All right. So sometimes if you have a company and you need to borrow money, a company says, okay, we'll lend you $50,000, but you have to keep a minimum of $5,000 in this account. Don't go below it. Otherwise, we're going to call the loan in and you have to pay the full balance. And the reason why they do that is so that the company can maintain sufficient liquidity or money in the account so that what? When their loan payment comes around, they can get it. Okay? And so oftentimes lenders try to use a compensating balance to try to ensure that borrowers always keep a minimum in the account such that they can get their loan payments and they don't run out of the liquidity or cash they need to meet that particular commitment to the bank or lender. Okay? Because as you know, we'll clean the account out when the loan payment comes, and then we'll say we'll pay it when we get the money from our receivables. All right.
Mr. Wilkerson, I have a question right there, right? Based on the definition that you would have stated.
Yes.
So I know with some banks, let's say for example, First Caribbean, on the checking account, you cannot have anything less than 500 or else they will charge you a particular fee.
Yes.
Does that tie into what we were just speaking about?
I'm so happy you mentioned that. Yes, it does. And it does not from a lending perspective, but it is a kind of compensating balance that banks have decided that they're going to put in place because persons have been running minimal account balance like $10 and $30 and $2.75 or whatever the case might be. And a lot of banks have decided that it costs them too much to manage an account that way with such small balances. So God forbid. So what some of them have done is say yes. If your balance goes under 500, we won't close the account. We'll just charge you a fee. Of course, that is designed to keep the account balance at a significant amount of money above 10, 20, 30, or $50. But also, it's an ingenious way for banks to do what?
Make money?
Make money. Hacer hecho dinero. Make money. And who is going to normally have account balances under 500? The majority of the population or the minority?
The majority.
Minority has it under.
No, the minority.
No, the majority.
The majority, sorry.
Yes. Us hardworking, half dead, poor middle class. Well, not middle class, some middle class. But yeah, the majority of hardworking people are going to have balances under 500 or most of the time. And so they, as usual, they're making a bunch of money from who?
The poor, I always exploiting the poor.
Yeah, the poor. Should I say flicking? No. Anyway, the poor people. Unfortunately, what the hell are they doing? Charging poor people a fee for being under 500? What poor, hardworking thing on them with children and all kinds of bills? Everything happened. The car stopped, the light off, and all that. It's
That's the truth.
I always, people have asked me in the past, Mr. Wilkinson, have you thought for running for office? I said, no. Because they said, why? I said, because I wouldn't last as long as party lasts. Because if I'm going to want to fix, they have to get rid of me. And I don't want anybody shooting, burn up my car and hurt my children and my wife. I don't want that. Because I can't just sit and let it be. That's my problem. So I have to stay away from it. See my point? Because that's madness. Because if I had anything to say about that, I'd call them in. All the heads in the bank, in my office. Down on, where's the Prime Minister's office? Wherever it is. And I will ask them, why do you keep doing this to poor people? Why don't you put something in place and get money from rich people? And I'm giving you a month or two to stop. And if you don't stop, then I have to stop you. Because this is not fair. Stop exploiting poor people. But yes, thank you so much for that question. It is a kind of compensating balance, designed, of course, for other reasons as well. But you're right, it is. Very good observation. Okay? If only compensating balances were designed for persons, companies getting loans to try and maintain a minimum liquidity for loan payments. But the $500 thing, like my grandma used to say, sorry for, young people. Okay. Yeah, this is interesting. You learn a lot of just that simple compensating balance. All of a sudden, all kinds of interesting things came out of that. So I tell you, accounting is not just debits and credits and trying to get through an exam. It has other interesting things for life and limb and companies. If only you can recognize them. All right. Of course, accounts receivable, on the other hand, we know money is owed to the company. and they're tied directly to what we call credit policy. What is a credit policy? Anybody knows? What is a credit policy or lending policy?
Outline.
I'm listening. Give it a shot. Let it rip. Don't worry about if it's right or wrong. The hell is right or wrong? Just let it rip. If somebody says we have a credit policy at our organization or a lending policy, what comes to your mind?
I guess it's like a set of guidelines to follow.
You guessed right. It is a set of guidelines to follow with regards to the bank's or the lender's lending and collections operation. Absolutely. See what happens when you let it rip? All right. So that's what a credit policy is all about. And so receivables for especially for merchandising companies, remember that word merchandising is no longer foreign to you now, is it?
No.
It may have been foreign 11 weeks ago before we started, but it's not foreign anymore. Because we saw merchandising, that word, when? Recently. When we were talking about what?
Inventory.
Absolutely. So on it? Man, this is great. This is the beauty of learning stuff. We all want to pass the exam. That's the ultimate goal. But the ultimate goal is when we've passed it, that later on we still remember in case we need it. Oh, sorry if I made that dramatic just to get you to remember. Okay. So receivables come around because we give stuff on credit. Whenever an organization gives credit to anyone, for example, if Kelly buys some paint from a supplier in the United States for $100,000, and the supplier says to Kelly, "You can pay us in 30 days because you're a good customer," then that is credit. Okay, so the supplier will then have a receivable on the supplier's books for the paint and say, "Now Kelly's in the Bahamas owes us $100,000. We expect to get it in 30 days." That's how receivables come about when credit is granted. Okay? And if you don't have a policy, see, we back to that again, credit policy in place with regards to how to collect receivables, then nobody will be assigned to watching that. Nobody will be assigned to following it up. And if Kelly don't pay, then your 100,000 is sitting in Kelly's bank account instead of yours. Does that make any sense, folks? That's how serious receivables are, and that's why it's part of the cash management discussion. Because the point about receivables is to get it converted to cash when? Sooner or later.
Sona?
Sooner. Okay. Once upon a time, when I was a younger professional, I used to do client work, and certain clients used to give me a check after I'm done with my work that they know was bad or couldn't be cashed that day or right away. So they'd said, "Here's a check," and they know very well that they're not going to have the funds in the account for another day, 2, 3 weeks, or whatever it is. And so I would go to the bank and deposit it, deposit my check. And then after whatever the clearing time, the check is returned. No funds available. Call the client, is, "Oh, I didn't get to." So after a while, I started thinking, I need to manage this receivable a little better. So what I started doing is, as soon as they gave me the check, what do you think I did?
Deposited?
Hell no. Because depositing takes 2 to 3 days to clear, correct?
No, you want cash. You could cash that.
You said cash.
Cheryl, cash.
Oh, way to go.
Cash.
Way to go, Cheryl, over in my corner. As soon as they give it to me, I didn't wait until the next day to cash it. I drove where immediately to the bank
Yes, to the bank.
to cash it immediately. So if they didn't have any cash on the account, I would know immediately and I could do what? Follow up immediately. See my point? But if they did have cash for something else, I'd be one of the people to get it first before they could something else it. How about that? That's what we call receivables management. I even had a client once who said, "Man, Wilkie, I didn't know he was going to bank the same day." I said, "I didn't know either. I just happened to fall in there." by accident. Because I've had my experiences with depositing from certain clients who, by the time it's cleared, there's no money because it's gone to other issues. But I say that only to say to you guys that it's all part of the receivables management process. Okay? Again, this is great information for people who run companies, but it's also great information for people who run households like you people and me. All right? If you look at figure 3 on my screen or in your textbook, you'll see that there are some colors there, some are receivables. And notice the description is receivables as a percentage of total assets for certain industries. Which industry has the highest receivables percentage?
Advertising.
Advertising. For some reason, advertising firms in the world tend to give quite a bit of credit for whatever reason. Why do you think that is so? Why would advertising companies do that, do you think? Maybe it's the nature of the industry. Remember, advertising might be where you prepare a set of work and then the person says, okay, fine, we'll pay you because we have a schedule. We don't pay until we satisfy the product. Whatever the industry practice is, they end up being the ones with the higher or highest receivables compared to the particular assets of that company. I guess the advertising industry know why they do this. I guess they get most of their money back in some season, but I suppose this is to encourage customers to come to them, take their business, and they're prepared to wait for payment once they can get your business. So a lot of things determine and the credit policy of the organization. All these things would affect how they're going to give credit to a particular company or customer. Right? Whose rate is lowest? Whose receivable totals are lowest?
Grocery stores.
Why?
Because you must pay when you pick up.
Yeah, you must.
POD.
Yeah. Has anybody tried, like, when you reach the cashier and say, can I pay for these next week?
No.
No. Food stores don't give any bloody credit. If you don't have any money, thief something or drop dead or beg, but they don't give credit. See how small that rate is? 5.9%. And I don't know, the owner must be give credit to his mommy or something. Because they certainly don't give it to anybody else. Of course, if you know a store that's
Probably loan to the employees, maybe.
probably, yeah. Employee loans, that's it. No food credit. Hell no.
Probably to the government too, like how a lot of stores were giving out groceries and stuff like that during the pandemic. Like the government probably set up something where they got it.
That's true. That could be an explanation in the real world where you might see a small percentage. Absolutely. Okay. But we know, other than that, when you reach that cash thing, you better have money from somewhere or start putting stuff back. Anybody ever been in that position where you go to the cashier and the bill comes so high, more than your budget, and you have to put stuff back?
It comes out more than a budget, but depends on what's, I try to put the most important things on the belt first.
I don't blame you.
Yeah.
Yeah, and guess what? If you run out of money, once you have your most important things, you have to leave the rest, then leave them. Don't worry about what people say. Look at, she have to leave that. So what? To hell with you. Well, not to hell with you, you know what I mean? Doesn't matter.
Well, shop at Super Value. If your cash run out, you could use your stamps.
That's true.
What I do.
Hopefully, when
I normally use my stamps at the end of the year. Like when you tend to do the big shopping, the extras.
oh
So I
yeah,
normally use my stamps at the end of the year to cover that extra. So I try to stay within budget. Sometimes you may go over $50 or here there, but for the most part, I try to stay within budget.
Yeah, and try to shop on Sundays for like the double stuff.
Double stamps, you correct.
Stop it. They still do double stamps on Sunday?
Yes,
Yes,
they do.
they do.
And I need to change to Sunday.
Well, that's the only way you could get something back from these absorbent prices he charge anyway.
You know, there's an old saying that it pays to talk about things sometimes, and it definitely does. I had forgotten about that double thing on Sunday. I need to
And
change.
that's only a priority for me right now because I just moved into my house and I'm by myself.
Oh my God.
Now something are a priority. I'm no longer with my mommy.
You never poor baby. All hell's gonna break loose now.
I
You
guess
have
what
to-
helps, and what helps too is like looking at the screen, because the other day I purchased like a bag of grapes. I always just buy the green grapes.
Right.
It was like $15. I was like, $15 for a bag of grapes?
Sure, for double.
Mhm.
Yeah.
Like
I
that all-
I agree. Even if you have money, you still take it out the thing and put it down because that is absolute mad.
Ridiculous.
Unless, of course, you have money to burn. Okay?
Yes.
Or your doctor tells you that they will help you to live well beyond your time or some nonsense like that. Okay? But other than that, it is absolute madness. I think they're probably overpricing the luxury items, quote unquote, the healthy stuff, whatever it is they do. Somebody needs to go and check more than just bread basket items. Because I think perhaps they're making a killing of non-bread basket items, including life-saving grapes.
Yeah, they are. Insurance companies, they're overcharging insurance companies also if you have insurance.
Please don't say insurance, because I need to finish this
I
class.
went for my prenatal visit somewhere and they give me a bill. They was like, "You're paying cash or insurance?" I said cash. So they give me the bill. Then I say, never mind, I don't have enough cash. You could do my copay for the insurance.
Absolutely.
The lady was so upset and she was trying to change the insurance. I was like, well, we have a different price if you're using insurance.
Yes, they do.
The insurance was like quadruple the amount they was.
The walk-in clinic, yeah, when you use your insurance, I experienced with the walk-in clinic, like because they know your deductible is 300, automatically your bill is 300 and some dollars. As
Yeah.
opposed to if you're paying cash and you just pay the 125 for the regular visit.
Yes.
The same like the maternity packages, it's still quadruple. So if I was paying cash, I would spend like a measly $3,000, $2,500 cash out of pocket if not using insurance. But now I'm
Absolutely.
using insurance, I am spending $8,000 to $10,000 just for normal delivery, just because we're getting the funds from the insurance
Which
company.
is one of the reasons why insurance premiums are not going down. Soon you're gonna have to rob banks, and I don't know what else to pay an insurance premium. God forbid. And even if you work for a company that has insurance coverage, when you leave, you're stuck because it's going to be very expensive to maintain any coverage because the prices are out of the window. And every year they're increasing it for no reason, even if you're not claiming. This is why is it going up $70? Because we have done it across the board and they hang up the phone almost. Get the hell off the phone. If you don't like it, lump it, let it lapse.
Yeah, because I realized when we had Dorian, Nassau was not affected by the hurricane, but they carried the insurance up across the board. I would have thought that those persons who would have claimed for the insurance at that time would have, their insurance would have increased. The insurance increased across the board, everyone, including the persons in
It
Nassau.
don't work like that. One claim affects all.
You understand? Like, when we had, I think that was Matthew or something, a few years, I can't remember the name of the hurricane, when some claims and stuff like that, I could understand. Like when you hit your vehicle, your car insurance would increase because therefore you're using your insurance to claim in order to fix your car.
Sure, that's the way we understand it.
Same concept would have been the same,
Look, you're right. It should be the same. But insurance company like banks continue to get away with murder. Okay? Even if you don't have a disaster at all, if they have a disaster in freaking China, they'll say, oh, the underwriters have increased it all over the world.
Mhm.
So we're paying for other people's disasters in Nassau. And this crazy stuff. And people have the attitude, if you don't like it, get the hell out the boat and let your house burn up with you in it. If you don't, they kind of behave really weird when you start trying to find out why the rates are so high. So my point is, yes, it's criminal, and nobody is doing anything about it because the only person that can do something about it is the government of any country. And if they don't get involved, dog eat the lunch of regular people. All right.
I wanna just put an example. Not like this was my experience too with the insurance company. I was paying insurance for my son, and I had they had returned two of my checks for no apparent reason. And
Right.
I can state who the insurance company was. It was Kalina.
Yes.
And I had called my agent, trying to find out why the check was returned.
Right.
And he said that he doesn't understand why, and he will get back to me. Anyway, he did get back to me. He said it was an error on their behalf. So therefore, they'll just go ahead and resubmit.
Right.
So I was like, okay, it was not my fault. Funds are still on the account.
Right.
And so I should not suffer that $25 penalty fee for a return check.
You should
So
not.
anyway, that's the first time. The second time they did it, and I was livid because, normally when you have 1 month or 2 months lapse in your insurance and stuff like, your insurance would tend to lapse.
Of
So
course.
what I did, I said, you know what? I said, for Kalina being a big company as you guys, I don't think it's fair. You understand? Because something could have happened to my son. It was a life insurance policy. And I said that when if something would have happened and I needed to claim, then you guys would have told me that, come up with some issue. So what I did, I closed out the policy, and my agent at that time, he didn't even tell me that, okay, I signed the documents to say that the insurance policy was closed, but he didn't even tell me, okay, well, you would need to come to the office because your insurance has a cash value. So like about 5 months had passed.
That's why he didn't tell you, because he didn't want you to benefit from the cash value. And they
So
should.
like about 5 months have passed, and this is just for information purposes for everyone in the group. So when you have something like that, so therefore the insurance is really and truly paying my premium based on my cash, what I've already accumulated in the insurance policy without my knowledge.
All right.
So a new agent had contacted me and said, hey, Mrs. Pratt, I noticed, I looked at your file and whatever, and I realized X, Y, and Z. And I just want to bring this to your attention. Had she not called me, I would have not known to go to Kalina to pick up my $2,000+ that I had left in policy. And I was livid.
No.
Livid.
Thank you very much for that information.
You have insurance, you have cash policies, and if you do decide to cancel it and whatever the case may be, please go and cut you a check, because even though you would have canceled your policy, in their system, your policy is not canceled. They just use your cash that was accumulated to pay your premium until it is finished.
Correct. And
then it's canceled.
And therefore keep the money. Like I said, a lot of criminal things are going on, not only ridiculous increases in premiums, but a whole lot of other interesting things. And nobody seems to have the nerve, time, or interest to bring the insurance companies to account. Okay? And believe it or not, that is a liquidity issue. That is a receivables issue, because as long as they were holding her cash value, she didn't have the use of it. And that's the same thing that happens with companies who are owed money. As long as somebody else has your money, doesn't matter if they look pissed off with you because you asked them, they have use of it and you don't. And you were kind enough in the first place to do what? Give credit. See my point? Yet the people you give credit to, oftentimes when you try to get the money back, they act pissed off with you, like you are interrupting their lives, rather than flicking apologizing for not paying and then pay, or promise to pay and then pay. Sorry, Paisa made that sound dramatic just so you could remember. So, yes, thank you very much for that feedback. It is actually even a receivables liquidity issue. Because had that not happened, my dear, you would have been out of $2,000 plus, and the big old fat insurance company would have kept it. And who the hell needed it more? Them or you?
Of course, it's always you.
Of course. Okay? And I say them for a reason because I don't want to say no them. They need to stop that nonsense. And I've been saying that from my hair was black and I had an afro. And everybody get mad at me when I raise it because nobody wants to deal with it. If you don't like it, jump off the ship and drown. Stinky customer. Now pay your premium or get out. They don't say it like that, but at the end of the day, it seems that way. All right. So this thing about managing receivables, as you can see, it has all kinds of connections right up to that example that she just gave a moment ago. That's the receivables issue, whether you realized it or not. Okay? So this is very, very serious stuff for organizations. Some companies even go under because they don't collect their receivables fast enough to pay their bills. They become insolvent and they have to close their doors with a bunch of money owing to them. Had they been paid what was owed to them, they'd still be in business, many of them. That's the point. That's how serious it is. Okay? All right. So if any of you had loans with somebody in the United States for whatever reason, you'll see why. When you owe people in the US money, they call you every 5 minutes if necessary. They don't give you a chance to breathe. They wake up in the middle of the night, call your priest, call the Pope, whatever they have to do, because they want their money and they want it when they're supposed to get it. And you're wondering, like, why are they harassing you? Well, maybe, but there's a reason why. Because the longer you take to collect money, the longer it makes people feel they don't owe it. They stop paying. It's harder to get it. That's why they harass you. You don't believe me? Lend money to a family member and ask for it 3 months later. They'll tell you you didn't lend them money. When? No, girl, not me. You didn't lend me no money. And besides, if you did lend me money, why are you asking me? I'm your sister. You're asking me for money back for. But you promised to pay. I know. So if I don't pay, I don't pay. What you gonna do? I'm your sister. And then you just like, oh, I'm gonna mumble and walk. Okay, next time I'm not. All right. So welcome to the world of cash, receivables, and liquidity. Very serious business, even though you may not have thought so before. And so how do we manage these receivables? How do we evaluate our receivables as a company? Well, we use ratios again. Remember that? In case you thought you were doing all those ratios, you're wasting time. You were not wasting time. I had you go through those ratio rituals because they have substance for then and now and later. And once you understand how they work, you'd be surprised how you could apply them. That's the beauty of information. Sometimes we have information we don't even know how to apply it. We don't remember how to apply it. We don't think we could apply it. And oftentimes we could to our benefit. That's the other thing. Okay? Because this same receivables discussion today, be surprised, it might benefit somebody in this group. Like, what? Man, let me go get my money. I don't care who, give me my money. So I'm not like that, but can I have the money, please? Because now you understand how important it is, even if it didn't dawn on you before. All right. So how do we manage receivables? Well, the big thing about receivables is something we call receivables turnover. And all that means is a company says, how long does it take us to get our money back? Okay. And so there are two ratios I think we use called day sales collected and another interesting one. Let's look at day sales collected first ratio. What's the formula for receivables turnover in your text? The formula, simple formula. Anyone?
Net sales,
Divided by average.
Yeah, average accounts receivable. Now we all are average pros now, aren't we?
Yes.
We should be. Beginning accounts receivable plus
ending accounts receivable.
by 2. That's how we tend to do it in accounting and on average. Okay? So we're now average pros. So in this example, the receivables turn over 6.8 times or almost 7 times. And your text tells you that that means what? What does that receivables turnover ratio mean?
It's a percentage, right?
Well, it shows how long it takes to collect your outstanding receivables. Okay. So in this case, let's say you give credit throughout the year. It takes, and what we say is for the entire accounting year, we collect all the credit that we give back 8 times during the year, which is a good ratio, by the way. Because remember, the higher your turnover ratio is, it means you're getting your receivables in faster. If your turnover ratio is slow, like 2 times a year, that means it's taking you too long to get your money back. Does everybody get that?
Yes.
That is a serious ratio. So you want that to be as high as possible because you want to be getting your money back as quickly as possible. Okay? By all means. So based on this 6.8 times, that means that roughly 6 into 12, you're getting your money back each time every 2 months, which is not bad. Oh, every month is better, but you live with 2 months depending on what industry you are in. Okay? And then the other ratio is called what?
Sales collected.
Yeah, day sales uncollected. And what that means is, first of all, the formula is 365 days out of the year divided by receivables turnover, which is 6.8 times. So this 53.7 days or 54 days means it takes us a roughly 54 days to collect our money back. That's kind of long, but depending on what industry it may not be too bad. But usually in business, we want to collect our money back in 30 days or less. Some industries, because of the nature of the business, the seasonality, heavy construction, whatever it is, the type of product, it could take 60 days or 90 days or even 120 days. But whatever is the industry standard for getting the money back, that's where you want to be in that ratio for the industry you are in. So if you're in an industry, for example, where the turnover ratio is low, and you're collecting higher than the industry, then you're doing better than those in your industry. If your ratio is lower than industry, then you're doing worse off than those in your industry, and you need to do something to pick it up. This is why companies have what we call an accounts receivable department or collections department for the same reason, to monitor, follow up, and make sure that the money is coming in as quickly as possible. That's the deal. Because remember, your expenses do not slow down. They come in faster than revenue. Sometimes they end up being more than revenue. So you have to always be looking for ways to maintain your liquidity in the company so that when your bills come due, you can pay them. Okay? Now, in some industries, there's what we call the financing of receivables. For example, if a company is not collecting its money fast enough, they have other options and they run into cash problems. The world is not over. There are some options for companies to seek out if they're not getting their receivables fast enough for some reason, okay? Whatever that reason might be. And for those of you who've gotten to it already in your reading, you'll see that there are some factors out there. And factors have a very unique job. They buy receivables. Does everybody see that somewhere in the reading? Yeah, factors buy receivables from companies. But if the company's total receivables are, say, $5 million, the factor will not pay $5 million. They're looking to pay less than $5 million because they're buying it from the company and taking on the risk that some of them will not be paid. Okay? So if you need money quickly and you cannot get your money in as a company, you can sell the receivables to a factor who are in that business. And if your receivables are $5 million, they may say, I'll buy it from you for $4 million. And if you need money bad enough, you'll grab it and run. Write off the other million. Let the factor worry about it. You follow? So that option is out there, even for those of you who may never even have heard about it. It's pretty big business in the United States and Canada and the US for those larger companies and middle-sized companies who find themselves in cash flow problems and cannot collect their receivables fast enough from their clients for whatever reason. Okay? Factoring comes with recourse and without recourse. What does with recourse mean, anyone? With recourse.
That the seller of the receivables are liable
Yeah.
um,
To
to
the
the,
uh-huh.
yeah.
If what?
The receivables are not collected.
Cannot be
Yeah,
collected.
so like a consignment arrangement. If the receivables are not collected with recourse means that the seller will have to cover whatever difference it is in terms of what accounts are not actually paid. Of course, the seller does not necessarily want to have that arrangement. Once he sells it to the receivables to the factor, who's the seller? The seller is the company with the receivables on its books.
351.
Yeah, and usually a seller when they sell receivables to a factor, they don't really want to hear about it anymore. Give me the money, you're already getting it for a discount. Give me my money, let me go. But some factors have a recourse feature so that if they don't collect the money from the customer, they can go back to the seller and say, "You didn't collect this one. You owe us all of that or a percentage." So I suspect we'll see more without recourse, which is the opposite, than those with recourse, okay, for obvious reasons. Once you sell your receivables, you don't really want to be responsible anymore, unless, of course, the factor forces you. Question?
No, so Mr. Wilkinson, in case like this would be similar to how a collection agency would operate?
Similar, but not quite. Similar
Okay.
in the sense that the company would transfer overdue accounts to a third party. That's how it's similar.
Okay.
Remember, what happens? Collection agency, they don't actually buy the receivables.
No.
They just work them,
Okay.
and then they get a fee for each one they collect. Okay, that's what agencies do. Factors actually purchase the receivables outright, take
Okay.
ownership of them, and
Okay.
are totally responsible for them after the sale. Yeah, but it's similar in the sense that it is passed on to a third party, and that's where the similarity stops.
Okay.
Okay, good point. Good point. There are some people who think that collection agencies are factors, but in the real sense of the word, they're not, because they don't purchase receivables. Now, there might be some collection agencies out there who do purchase receivables. See my point? But if
Okay.
they are out there and they call themselves collections agency, that's okay, because they might purchase some and work some. You follow?
Yes.
But so some of their work is collection agency, and other their work would be factoring. So they'd be like a hybrid company, wouldn't they? Meaning that they're doing both.
Yes.
But typically, you don't see them doing both. Collection agencies just collect and get a fee. Factors purchase the receivable portfolio outright. Okay? So that's a great point. Okay. Now, this thing about agency duties and factoring and all that uh, tends to create what we call a contingent liability for companies, especially with regards to when factors kick in and they say, hey, we'll buy your receivables, but we'll do it with recourse, meaning that whatever we don't collect, you will have to pay us for them or cover some of the cost. Usually, when this arrangement is in place with a factor, it creates what we call a contingent liability for the company. And contingent liability, if you don't know, is really a potential liability. It hasn't evolved, it hasn't materialized yet, but it's based on whether something else happens in the future. So if the factor doesn't collect the money, then the contingency becomes real when the factor goes back and say, look, I didn't collect this one. I need my percentage or I need my return or as agreed. So then the company has to pay. All right. So the contingent liability then becomes real. Until it becomes real, it's just contingent, okay? Potential. It's like dating. Dating is a potential liability until you get married, people say. And then the liability becomes real. Is getting married a liability?
Could be.
Yes.
Yes.
It could be.
I guess it depends on who are you marrying, because sometimes it could be an asset.
Yeah, very often it can be an asset, which is one of the reasons why a lot of people get married. Because somebody said to me the other day, I was talking about something, and I said, what does love have to do with it? It's all about other stuff, they say. So yeah, it doesn't have to always be a liability. Sometimes the liability is contingent for some people because they think they're marrying an asset, and then later on they discover they married the asset is contingently a liability. What about children? Are they contingent liabilities or are they assets?
Mm-mm. Mm-mm.
Their liability.
But they are a liability until they become an asset.
Exactly. That's what they are.
If they become an asset.
Right.
So that's a
if they
risk.
become an
That's a
asset.
risk.
Well, some do. Yeah, it's a risk. It's risky. No guarantee.
None.
And they remain on your books forever.
Until you die or until you're too old to be concerned about like the hell with.
Yeah.
As long as you're cognizant and you're moving and all that, yeah, they stay on your books until life forces you to write them off somehow. Like you get too old, like man, whatever, and then you start letting it go. But until then, yes, it's a strange contingency. Children. This is why the Bible said. That's why the Bible didn't say anything about asset and liability. It says it's for your joy. How is that?
Yes.
That is sick. Yes. Contingent liabilities. So if you hear contingent liability, you know that it's something you may have to pay if something happens. If it doesn't happen, then you know you will not have to pay up. Okay? For sure. All right. So those guys who shot up the 6 guys, they contingent liabilities or assets?
Contingent liability, because if they're found, they're gonna have to they have to pay up.
And even if they're not found, they're already contingent. They already killed 6 other guys who may have killed somebody else anyway. But that's another story. It is unfortunate either way. And when you think about it, you think, what a waste of Pampas time. Or maybe nobody wasted any time on them. Maybe that's why we have the problem. That's my point.
Probably so, more than likely.
Yeah.
Not much been put into them.
Yeah. So we as parents sometimes create contingent liabilities because we don't parent properly. Like the old people say, we drop the chair in them and then we do what we doing. And the chair and them grow up on their own. Anybody ever heard that Bahamian expression?
Mm-hmm. Yeah.
Yeah, it's still relevant, unfortunately. All right, so that's a contingent liability. And then we have other ways that companies generate cash through what we call securitization. All right, this is a fancy word where a company puts together all of its receivables and sells them off in batches at a discount. It's similar to factoring. Okay, factoring tends to purchase all of them, the factor. Under securitization, they break them up in batches depending on what is most likely to be collected, average collection, least likely, and they sell them at different prices for each batch depending on the likelihood of collections, etc. Okay, so if you hear that word again, that's how companies try to get their receivables back, by selling them off in batches. Okay, all right. Of course, those that are those batches that are a lot more likely to be collected, they would have a lower discount, and therefore the company would get more money back for them. Those that are higher risk to collect, they would have a higher discount from the buyer, and therefore the company is going to get less money. But the point is, when companies get around to this stuff, it means they need money and they cannot get the collections in. So they have to find a factor or sell them out in batches under securitization to try and get money. So money, sell off. Okay, like Peter Nygaard. Anybody who knows that name?
I think everybody.
Yes.
He's been in the papers, right?
That's
Yeah,
all we know. That's all we
Canadian.
know. Yeah.
That's a
Do
Canadian.
we know anything else about Peter Nygaard?
Yeah.
I think he has some kind of trial going on currently.
Yes. Is he a former resident of the Bahamas?
Yes.
Yes, he is. Yes, he was.
So those youngsters in this group who've been reading the papers, or maybe you're not familiar with the old NIGAD thing. So perhaps when you have a moment somewhere, you can Google it and see what that former resident of the Bahamas was up to according to reports. But yes, he is now in prison in Canada. The United States government is seeking to have him extradited to the United States on charges of human trafficking and money laundering and corruption and so on. But yeah, he used to be a former resident of the Bahamas. He has assets in the Bahamas. As a matter of fact, the newspaper last week had a front page piece where he's trying to sell the Union Wharf downtown that he purchased a couple of years ago when he was not considered a fugitive for some $15 million. And the reason why he's doing that is because of what we're talking about now. He needs to be what? Liquid to pay those legal and other bills. Do you understand how this thing works?
Mhm.
Okay, that's good. Because you never know when you have to sell off something for it to become more liquid. You say, mother sick, good thing I do that class. At least I understand some of the language.
The goal is to,
Uh-huh.
hopefully you get a fast sale for it.
Hopefully, not
You
necessarily.
get a quick.
Hopefully, we always want a quick sale. But as life is what it is, sometimes it doesn't work like that. And sometimes the sale comes slowly. By the time the sale comes, you're almost bankrupt. But we always hope for the quick sale so we could avoid the stress and get the money we need to do what we need to do. Absolutely. The important thing is the more bits and pieces of information you have, the better. Because some people think, oh, when I do an accounting class, I'm just doing debits and credits. Maybe because that's what the world of academia make you think sometimes. Like, I'm just doing debits and credits, stinky balance sheets, and all that homework Mr. Wilkinson gave me to do. I don't have nothing to do and all that. I know that, but it's not only that.
Well, Mr. Wilkinson, the class has already helped me because I'm on the vestry board of my church.
Yes.
And so we had a meeting last week and we were given balance sheets and cash flows. And I was like, oh yeah, I know what this is all about.
Absolutely. Now you can look at that.
So when people started asking questions, I was like, oh, y'all need to come to my class.
Exactly right. And there you go. So this stuff is not just for the companies we're talking about, the merchandising and service firms. Of course, they're the ones who are primarily involved in this, but yes, this thing has a lot of personal benefit as well. Absolutely, Dion. So now you're in that double vestry thing, but a whole different perspective.
Yeah, so I could see if
Yep.
the account doing what he's supposed to do.
And then when you'll be asking him questions that he can't answer, and then he said, "We need to get off this vestry board."
That sometimes be the case.
Oh, God. Yeah.
Okay, so yes, welcome to the world of academia. It's more than just debits and credits and passing an examination. Trust me on that one. All right. Accounting estimates. Okay, so we have these receivables that we try to convert to cash when we need it. We look at the different ways we try to do that, but sometimes in all our efforts, we still don't get all the money. We have to end up with uncollectible accounts or what we call bad debts. I know you've heard about bad debts. I hope. And bad debts are just those accounts that companies cannot collect for some reason. They've tried everything. From those to collection agency to factors to securitization, whatever, but they get stuck with them and they have to write them off. Okay? And companies never like to write off bad accounts to bad debt because every time they write it off, they lose that amount of money. So if somebody owes $5,000 and they don't pay, you have to write that off. So that reduces your profit by $5,000. That's why companies keep calling you for their money because they don't want to write it off. They need it to not reduce their profits, and they need the money in their bank account to pay bills. That makes sense, doesn't it? Absolutely. Like some people, like certain family members, for example, if they don't feel like driving, they'll call another family member and say, go down there and get that thing for me. But what happens is when they say that, first of all, you have to get up. Correct? Correct?
Correct.
Yeah.
Then you have to interrupt what you were planning to do. True?
Mm-hmm.
And you have to drive there. Whose gas are you using, theirs or yours?
Your gas, nothing comes free, eh? Someone
Nothing,
gotta pay.
nothing, including the time it takes to get there. Pay for that. Now, I'm not talking about an invalid parent or grandparent or somebody who's sick and can't move. That's what I'm talking about. I'm talking about a person who's home. They just don't feel like it, they say.
Yeah, lazy person. Yeah.
I don't want to give it a name, even though that is the name. But that's an excuse to use other people to do whatever they want. In other words, I'm saying there's a cost involved for everything, even though it may not appear that way. So when your bestest cousin or somebody or friend, and they just do it because they don't want to be bothered, if they don't want to be bothered, how dare them put the burden on you? Is that fair?
No, it's not fair.
Absolutely not. But we do it all the time. Is that a debit or credit? Depends on what part of the balance sheet you're on, correct?
Pretty much.
If that activity is an asset, then it's a debit, correct? Correct? Assets are always debited.
Debits.
However, if that activity they ask you to do is on the liability side of the balance sheet, which it usually is, then it becomes
A credit.
Credit.
because liabilities are always,
Credits.
equity is always, shareholders' equity is always,
It's credits, eh?
Credit.
credit. Expenses are always,
Debits.
revenue is always, losses are always.
Debit.
Thank you very much, Owen. You're still there, doggone it, among these doggone chicks. Anybody ever says chicks anymore?
No, they won't from that.
That's old school. You say chicks, now people get upset. I ain't no chick, right? All right. But yeah, back in the 70s and 60s, we used to say chicks. Anybody knows why? Anybody's old enough to know why we called girls chicks back then? Apart from the fact that it was just a colloquial back then. But there's a reason why we say chicks.
Because they were farming culture, society.
Maybe. That's a bold reason, but maybe there may be some substance in that. But remember, anybody ever had like chickens in their yard when they were growing up with their Grammy or something? Granddaddy?
Roosters.
Roosters.
Yeah.
Okay. What about mother hens? Had any of them? Yeah. You ever saw like a mother hen and her babies, like the little yellow chicks walking behind her?
Yeah.
Yeah. And they're called chicks. Okay. And so in the old days, we equated girls and our women with being little dainty, gentle, chick-like persons, like very soft and to be handled with care, kind of thing. That's how we had a general perception as men, anyway, back in the day, when things were different, when our women were like
Gentle.
yeah, like a little thing to behold. You just rub it and look after it, make sure nothing hurts it. Like how mother hens look after their chicks. They'll peck you to death if you come near one of them. And that's how guys were back then. We'll walk. Don't go next to, don't even talk, look you up. Like that. So that's why we said chicks back then. But now in the modern Bahamas and world, if you say chicks, people get upset. Like, I look like any chick to you? As a woman, babe, or whatever people say. All right. So I just old Bohemian history lesson. All right. So I think we get the idea about cash and receivables and all that, and how important it is. You could have all kinds of other assets. If you're cash weak and something happens, dog eat your lunch. It's always good to be able to find $300 somewhere if you could. Some of us, we have so many things going on We can't even find $300. The account is in overdraft. You need an overdraft facility and all that. And that's okay for a while if you need to do that. Companies do that all the time. So it's no disgrace if somebody needs an overdraft facility, just in case they have a month to go when they go over. As a matter of fact, for certain people, it might be a good idea to have a $1,000 or $2,000 overdraft facility if you can get it. You don't need to use it. You only use it if you have a what?
Emergency.
Yes, where you run short for some month, something unexpected happened, you can go over your account balance into your overdraft. You don't use an overdraft just because you could to go to Miami, because you really feel like after COVID, I gotta get out of here. So you spend 1,500 of your 2,000 overdraft to travel for no particular reason. That's not what you use an overdraft for, even though folks have been known to do that. All right. Overdraft is for emergency liquidity purposes, whether you're a company or an individual, and only to be used when it's absolutely necessary. Okay? Cash equivalents in accounting simply mean anything other than cash that can be converted to cash in 90 days or less. So if you have a CD, you could break it with that in 90 days or less. If you have government securities or 90-day government securities, you can sell it back if you need cash at a discount, get money. Anything that can be converted to cash in 90 days or less is considered a cash equivalent. Okay? An expression you might want to just keep in mind. Okay? Some people have asked, is cash and cash equivalent the same? The answer is no. If they were, we wouldn't separate them. Cash is the actual money that you have access to now. Cash equivalents, you would have to convert whatever instrument you have to cash, like a CD, like a government security that runs for 90 days from the central bank, or whatever the investment instrument might be. If it's something that you can convert to cash fairly easily in one form or another, then it's called a cash equivalent. Okay? And the reason why we have these equivalents because we can earn interest on them if we don't need the money, and then when we do need the money, we can get the money quickly. Real estate is not a cash equivalent, right? Right, folks?
You said real estate?
No, it's not.
Not.
Yeah, real estate is not a cash equivalent. Why?
How come?
How come?
Because there's no guarantee it can be converted in 90 days.
And it
or
takes
so.
time to sell a property. Like usually properties beyond,
Property, long time to sell.
yeah, so that's not something you get cash right away.
No, if
Yes,
you
but
need right away, that property deal may not help you. Now, mind you, you might get dead lucky like Tingham, and it sell in 1 week. See what I mean? But that doesn't normally happen.
yeah, no guarantee.
Okay? It can take anywhere from 30 days to a year or more to sell property. So property is not a cash equivalent. Property is not a liquid asset. Property is great to have when you can have time to sell it in the future if you decide to do that, but it is not great for meeting immediate cash needs like school fee. See? Your children will be out of school, home, watching Netflix and being educated from home while you wait for that property to sell. Because properties take time. Okay?
Yeah, we have some people rich in assets but have no cash.
Absolutely. A lot of people are like that for one reason or another. Nothing wrong with having real estate. That's great. But you have to have money on hand to meet those immediate needs every month when they come due. Nobody wants to hear you have property. That might be great in the long run to ultimately get you out the hole. And oftentimes it does. But for the immediate future, it takes a while. Okay? As far as liquidity is concerned. And how do we control cash? All right. Couple of ways. Cash is so liquid. How do we control it? Well, we have what we call the impress system. Anybody ever heard that in this class before?
Never.
The impress system. What is that?
That wouldn't be a cash flow or what you would do to start your flow, starting flow. Would it be that?
Yeah, that's a good point. Float.
I
Okay.
thought it was monies available for a little minor expense.
It is.
That could be float or petty cash.
Well, yeah, that's
Yeah,
actually,
cash it.
yeah, one of the key forms of impress systems is petty cash. Absolutely. Remember we did that entry last time. Anybody remembers that entry? What's the entry to establish petty cash for $50? Anybody remembers that simple entry?
Petty cash debit and cash is credited.
Oh, gone it. This stuff is actually working. Okay, absolutely. And yes, petty cash is one of the major forms of impress systems to control cash. In other words, if you have
That,
monies in the company, you pay small bills with them, you set up a petty cash, somebody's in control of it, they check it, they make sure it keeps balancing, they replenish it. Remember? Speaking about replenish, anybody remembers the entry for the replenishment of petty cash?
Debit cash, credit petty cash.
True or false? Anybody agrees with that? Replenishment of petty cash.
Credit cash.
and we have to debit the expenses, say.
Yeah,
We
we
have to
credit
debit
cash.
cash.
We credit
Oh,
cash.
the
Cash,
and
yes.
debit the
Take
expenses.
money off the bank account, right?
We credit cash and we debit the expenses.
The expenses.
My bad.
Okay, okay. Why do we credit cash to replenish it?
You debit it, you have to credit the bank account. You're taking money off of your bank account in order to put monies in the petty cash for float.
Thank you very much. I couldn't say it clearer than that myself. And that's really how it works in practice every single time. And the beauty with accounting, once you learn the correct procedure, it doesn't change. Only a few things change, like certain accounting estimates, which you'll learn in accounting too. By the way, I know I'm not sure if I'm teaching accounting two, but I know accounting two is coming up in the summer. Those of you whose companies or you have the resources to do it, I encourage you to do it back to back while a lot of this stuff we're doing now is fresh in your mind. If you plan to do accounting two, which I encourage you to do, because by the time you're done with accounting two, you'll have a really, really substantive background in the fundamentals. Okay? You could still run off into the woods with accounting one, but accounting two will add a few more important things in terms of the corporate world and certain other accounting investment issues that might be of benefit to many of you. So if you can persuade your company to pay, or you can pay, please go ahead and do it, so that you can put that under your belt and it can only benefit you, I assure you, in the future. All right. I know sometimes I had one or two students in the past who come to me and say, Mr. Wilkinson, I'd like to do a particular course, but I don't have the money. I'm like, haven't you ever looked at a credit policy before? You, some of them know. I said, you did credit and collections? They said, yes. And what, haven't you learned anything? You don't have to pay the full amount up front. Go in and do what, folks?
A payment plan.
Yes. A lot of things can get
Yes.
done with a payment plan. So if your fee is, let's say you have a 10-week semester, watch how ingenious I'm going to appear to be, as most of you already know. If you have a 10-week semester, why would you put it off because you don't have, let's say, $800 up front? You don't need it up front. You go into the organization and said, I don't have $800 up front for this bloody semester, but can I pay in installments? And most organizations will consider that, unless you're an outright credit risk for some reason, and they'll look at that. But if you do that, so all of a sudden, if you have a 10-week thing and you pay some every 2 weeks, that's 5 payments. So 800 divided by 5 payments is how much, somebody? I know you have a calculators in accounting class. How much? 800 divided by 5 weeks is how much? 160. 160 $160 every 2 weeks. How's that? Now all of a sudden you don't have to be up sleepless nights like, well, I can find, I don't know, $800. You make a credit arrangement, put the receivables on the organization's books, just pay it, that's all. And if 2 weeks roll around, you have 140, 130, don't panic and don't pay. Go in and do what?
Renegotiate.
You don't have to renegotiate. Pay the 130 and say next 2 weeks I'll pay the difference next two. See, like that.
Mm-hmm.
Yeah, that's all. So all of a sudden you're using a little and still getting done what you need to get done. You don't always have to like throw it down and say the hell with it because I don't have all that. No. Because trust me, if I had to find the money for all the crazy things I did with these bloody people, not my babies, don't mind me, but my babies and family and all that, man, I'd never get anything done. Okay? So don't let that keep you from getting things done. Go in and negotiate. People do it all the time. Okay? Including companies, by the way. You think companies, big companies, do everything in cash? They don't do everything in cash. That's why they get credit. Did you know that? And they use the credit facility to do their business until they get the money in, and then they sell some more and they get credit and like that. Look at what banks do. Do banks lend their own money? Do they lend profits? They mean no. Well, for your information, they don't. Whose money do banks lend out to people and companies?
Yeah, money.
Our money.
Money, yes.
Yes. They don't lend their profits. Their profits go in their bank account. They don't lend that. That's for their shareholders and for them to have fun with and get rich with. They lend our deposits. Make 12, 15, 18% on it. Put it in their bank account, the bank's profit account. And then collect that money back, put it in, lend it again. And again. For centuries. How's that? Okay. I know. It's debits and credits class. You learn some interesting things in certain debits and credit classes. All right. So the impress system, typically the petty cash system, is a control for cash. Why are we constantly looking to control cash again? Anyone? Why we keep controlling cash? Controlling cash. What happens if you don't control cash?
You try to prevent theft and misuse of funds.
Of course, you guys say it so delicately, like it's an impropriety that occurs only seldom. It is not an impropriety that occurs seldom. It occurs every single minute of every single day. Folks, it is a very serious matter. People are looking for ways to steal money all the time. And the less control you have over it, the easier it is you make for them to steal it. Check the record, go online, Google it every day. People even stealing money from the church. They ain't scared of God? No. I'm not sure how they do it, but they do it. They don't seem too concerned about it. Because the thought of taking money from the church to me is still spooky from when I was a child. My grandma already told me if you touch God's things, you got gag up. And that's just stayed with me whether it's true or not. But some people are not intimidated by that. If there aren't any controls in church, they'll carry it from there too. In fact, I understand people are breaking in churches now in Nassau. Once upon a time, that was unheard of.
Yeah.
Because you go in the church and carry anything. As far as we were concerned growing up, God can charge you and you never live a comfortable day in your life again. Mm-hmm. And after that, when you die, you go to hell too. But that doesn't seem to scare a whole lot of people these days for some reason. All right. So cash control is a very important thing. Another method of control is EFT. Anybody ever heard about EFTs?
Electronic funds transfer.
Also known as
Wire
Online
transfers.
Yeah, wire transfers. Okay. Why are wire transfers are controlled for cash?
Because it goes from one account to the next, you know, but cash directly.
Correct. Nobody physically handles the money to plan any hanky-panky. It goes directly and instantly from sender to receiver. Hopefully, they have the necessary signatures that we discussed in controls. Remember that chapter, internal control? The relevant signatures sign off to make sure that nothing, no hanky-panky goes on in the transfer process. Because remember, even though we take cash out of people's hands, we're still ingenious when it comes to money. If we don't have proper controls in place, even though it's being wired or EFT, how's that? Sounds pretty fancy.
You wire to the wrong account.
Yeah, the right, wrong account.
Well, that's known to happen.
The right, wrong account.
That's right.
We always find a way to get our hands on the money. And the weaker the controls, the more likely it is going to happen. Sooner than later. Okay? When my kids were small, I used to do a little thing. I used to put my wallet on the table for a reason, to see if anybody would try and sneak anything out of it. So it was kind of a test for them. Because it's not children's fault. They're going to do what comes naturally. They take it out because they want to buy candy when they go to school. That's what they're going to do. But it's important that they understand you don't move anything without what?
Asking first.
Exactly. It's not asking. There's nothing, especially if it's not yours. See, it's a basic rule. And you have to teach children that when they're young, so by the time they grow up, they don't do all kinds of crazy stuff that some people do when they grow up. Okay? So my oldest son passed the test. He never was tempted. And if he was, he overcome his temptation, for whatever reason. But my baby, who was a little more adventurous, he tried it once. He went and he took out $1 because he figured daddy wouldn't.
That ain't gonna do.
Yes, sir.
But what he didn't know was I set it up so that I knew when it was gone. All right. So I said, Dante, did you move anything on my wallet? And of course, his answer was no, Daddy.
No.
They never do it. Even if their hands in the cookie jar, I said, are you taking cookies? No. You get cookies on their mouth. Are you chewing cookies? No. Because from small, that sinful nature we're born in is automatic. That's why you have to teach. You notice, folks, you never have to teach children how to do the wrong thing. It's
No,
natural.
it's automatic.
Teach them to do the right thing. Wrong comes naturally. You have to teach the right way every single time. You don't have to teach children to lie. It's not their fault. Because we're born with that sinful lying thing. That's why you have to teach them how to tell the truth. Okay? And so I gave him one spank, like a real spank. And I said, I don't mind if you get it, son, because it's your daddy's. But you cannot touch anything that doesn't belong to you. Doesn't matter what it is. He's now 24 years old. Never ever did it again in life anywhere. In fact, he asked me the other day, Daddy, remember when I was 6, you did that one day? I said, I sure as hell remember. I'm just thrilled that you still remember. That's the deal. All right. So yeah, folks always look EFT or whatever methods. If your controls are weak, man, you're gonna have problems. Somebody's always looking to run off at something for an opening. No, most of us do the right thing, but that small percentage of us, we're always running some program, whoever they might be. Okay? And you can't tell by looking. All right. So, what about bank reconciliations? Why is that a control measure for cash? A lot of people don't consider the bank rec to be a control for cash, but it is. Why? Anyone?
It gives an account of all funds deposited to the bank on any transactions the bank may have received that's not recorded on the books.
Absolutely. When we do a bank rec, that's the kind of stuff we're doing. We're looking to see that when that bank rec is done, that the bank balance is equal to what? The company balance in the cash book. If you can't get them to balance, you have a problem, Houston, because they should always balance. And any errors that throw it out of balance must be what?
Corrected.
Correct.
Mhm.
Without plugging. Anybody knows what plugging is?
Putting in the amount to
Crossing the
balance.
balance.
Insert any amount that balances the account.
Yeah, the balance account.
So whatever's required to balance it, because we're not interested in looking for any differences. Or if we involve in something we plug to hide what we're involved in, or whatever the case might be. Either way, plugging is never the right thing. Okay? Accounting has a procedure, a short and over account, or some other similar account where you can put stuff if you can't find it, and it's time to find it or write it off. Yeah. But you don't plug to try to say that all is well. But plugging was a word we used decades ago, and I'm sure people are plugging as we speak somewhere, trying to make something balance to hide something. And sometimes plugging is discovered, and sometimes it's not. All right. So this bank reconciliation, if you work for an organization that doesn't do banks or bank recs or do them regularly, that organization has a serious internal control problem. A lot of small business in the Bahamas don't do bank reconciliations because they don't want to hire somebody to do it, or they don't want to pay their accountant a couple extra bucks a month because they already think they're paying them too much. And they, besides, as far as they're concerned, they don't need it. They know what their bank balance is. See my point, folks? Excuse me. Just do the fat thing or whatever. I know what my bank balance. I only know bank recs. Okay.
Wow.
So they don't really know if somebody in the bank is stealing from them, their account. They don't know if the bank make a mistake and indirectly credit or debit their account with an amount of money that shouldn't be there. You don't know anything without a bank rec like that. Still, they insist small businesses in the Bahamas in particular are not doing it. Some larger business don't do it. You'd be surprised to know who are not doing it. Big financial institutions and insurance companies and other companies like this, retailers, and some of them, they do it because the auditors force them to do it. Especially those companies have to be audited annually, like financial institutions. They force them to do it as part of the audit. And if you don't do it, then the auditors get upset. So you have serious internal control issues. We don't know if we can give you a clean bill of health because there are no bank recs in here, and you look like you don't want to do it. Why? And they get suspicious and so on. All right. So the bank rec is a very important document in case you come across a discussion in your organization or in your life. Um, Even for you personally, if you have a bank account, you should reconcile it. It doesn't have to be sophisticated reconciliation. Just check to see that everything is everything. Whatever you put in is there. Whatever went to your bank account, you account for it from your book, from your own account. Just so that if there's an error somewhere, you can pick it up, hopefully, sooner rather than later, because otherwise you may never pick it up. So this thing is real and real important. All right. So the first thing we consider when we look at the bank rec, and you'll see from the information, is that there are some transactions that appear very, very often and commonly in the company's records, okay? The company that we're talking about, and there are basically two categories: outstanding checks and deposits in transit. Now, the reason why these appear on the company books because whenever the company prepares a deposit, they have to pass an entry, correct, folks?
Yeah.
Right, everybody?
Yes.
Yes.
You're budding accountants now. When you do a deposit, that deposit slip has to go to the accounts department so that the journal entry can be done. My. Or maybe the journal entry is done at the point of sale and then the deposit is made and deposited. That's probably what happens in most organizations. Either way, a journal entry needs to be done for that transaction. All right. So when you prepare a deposit, that shows up in your books because you make a record of the transaction and then you deposit the money in the account. We say it's deposit in transit because the bank will get the deposit and open it up the next day probably, and then credit it to your account hopefully the next day. So until that happens, it's in transit, it's on your books, but not on the bank. So for example, if you make a deposit on the 30th at the end of the month, your balance and the bank balance is going to be different because you have the deposit in your books, but the bank hasn't posted it to your account yet. Do you see that, folks?
Mhm.
And so you need to be aware of that for any month-end deposits in your bank rec. Because if you're not checking for that, somebody in your organization can figure out you're not doing any bank recs, and then the deposit doesn't go to the account. How about that? Because nobody's doing bank recs to check. Hopefully, not too many companies are doing that, but some people's systems are that weak. All right. Outstanding checks also. Whenever you write a check, you record that in your book as a credit to cash, but you don't know how long it's going to be before the person with the check cashes it. Correct?
Yeah.
So if you do a bank rec, all the outstanding checks on your books, you will then reconcile that with checks to be um, processed at the bank, which are not processed yet. So you will add those to the bank account balance so that you can balance your bank account with your company account. The whole idea is these steps are designed to control transactions in the company, especially impacting cash. If you are doing these reconciliations when there are problems and errors, you'll pick them up. If you're not doing them when there are problems and errors, you will not pick them up and you will lose money. Like many companies are losing money as we speak every single day. And for some reason, many of them are refusing to put the controls in place, even controls as common as bank reconciliations. All right, so that's the company side. On the bank side, things are happening that the company will not get wind of until the statements arrive a day later, a week later, even a month later. Okay? So the kinds of things that would be on the bank statement but not on the company's books would be things like service charges. So at the end of the month, when the bank process service charges, you won't get that until you get your bank statements, correct? Correct?
Correct.
Correct.
And then when you get your bank statement, in order for you to pass the entry correctly, you have to have a bank reconciliation to show service charges as an expense. Do you follow, folks? Does that make sense? Because if it doesn't, this would be a good time to say, I don't get that. All right. So service charges will appear on the bank statement at the end of the month. When you get your bank statement a week or a month later, for some people 3 months, for some people, God forbid, later, and some people never, so because they don't reconcile and they don't care. So the bank can make an error at service charge instead of it being the usual $25. They can make an error and it could be $2,500. And if you're not doing bank recs, are you going to know?
No, you won't.
No, you won't. Thank you very much. No, you won't. I like that. And then sometimes people in the bank find out because of conversations when you're making deposit, everybody's yip yapping. They find out you don't do. Child, we don't do no recs. The teller say, "What is sick? Stop it. I've been a teller for 10 years. You don't do recs?" And I did an accounting class. So I know now if you don't do recs, I could take some money off your account and you won't.
Notice.
But Mr. Wilkinson, if you don't do reconciliations, wouldn't that become an issue when it's time to be audited?
Like I said, for those companies that are audited, they have to do recs. But there are thousands and thousands of companies that do not have an audit requirement, like small businesses and certain medium-sized businesses. And therefore, many of them don't do recs. Remember, we're talking about those companies that still don't do bank recs. There are many of them. Those who are being audited must do them. Absolutely. Okay. And so, and usually those are the bigger companies that are being audited because small companies can hardly afford a bloody audit unless hopefully it's being audited by a small audit firm like an independent auditor or maybe a small firm of 2 or 3 people where you can be audited for a reasonable fee. But once the big guns come in, you're going to have to pay a lot of money and small business can't pay. And a lot of small businesses are not required to have their small business audited, right, for one reason or another. And so if they don't do their own control measures like bank recs, they can lose money, as you can see. Because guess what? If I'm a teller and I find that you don't do that, I could find, or someone else, I could just siphon off maybe $200 a month. Who's going to miss it for years until something hit the fan? And we see that happen all the time. If something hits the fan, then it's a investigation is done, and then you might find out something. But things don't always hit the fan. Sometimes it goes undetected forever until the person taking money off just leaves or dies, and you never find out. All right, it's a good point. So service charges will show up on the bank statement to be reconciled on the books later on. Not return checks, of course. If the bank returns a check, you won't know that until you get your bank statement. They don't call you and say that. Any debits and credits for whatever source coming into your bank account that will be taken off, you don't reconcile, you wouldn't know they're there. And if you earn any interest on your bank account credited, and you don't get your bank statement to do Rex, you won't know how to process that. And all these transactions that are on the bank statement at the end of the month or during the month, you have, if you're doing bank recs, then the bank rec process will force you to process them in your accounting records. If you're not doing bank reconciliations, a lot of your accounting records will be understated because you will not be recording these transactions because you're not doing bank recs to see what they are. So, for example, if you have a service charge of $300 on your bank statement and you don't do bank recs, you're not going to have that in your expense account because you don't know, because you're not doing bank recs. But if you're doing bank recs, you see, oh, service charge 300, then you make an entry, debit service charges, credit cash. Now your books are in order. Debit, credit interest income, debit cash. Now your books are in order because you're doing these bank recs. So not only do you get to control your cash position, make sure people don't siphon money off, but you also get to keep your records in pristine condition by being aware of what needs to be adjusted to your accounting records. Okay? Very important process, this bank rec thing. Unbelievable, a lot of companies still don't do it. All right, and then after that, we have a nice little clean bank rec. In real life, they're not always that clean. Some bank recs could be 5, 7, 10, 20 pages, depending on how large the organization is. Fortunately, most bank, not most, but many bank recs are being done electronically now, through QuickBooks or otherwise. And so it's a considerably easier process. But for those companies that are not on QuickBooks and doing bank recs and all that stuff, then of course you do the manual. It's better to have a manual system than no system at all. Okay? So if you're a small company, you need to do it manually because you don't really need to do it electronically for some reason. You don't have that many transactions or whatever. Fine, just do it because you will find that that will definitely help you to maintain control of your cash position and also to make sure you have all the correct entries for the month in your financial statements so that your financial statements will reflect clearly what's going on and not leave anything out. Okay? All right. Now, for those of you who had a look at this example, you'll see that there's a mention of some things that are in circle, and then there are lists of things that went all the way down to 7 items that form part of this bank rec example. And again, this is a nice clean one. For most small businesses, that's how it'll look. For larger businesses, it looks like that. It just will have more entries sitting in it because you have hundreds of transactions. Okay? But again, if it's being done electronically, then hundreds of transactions will not be a problem. If you're just a small business, you can go in QuickBooks and do this once you learn how to do it. Even for yourself personally, your own bank rec, just to make sure nobody's taking $10 of your account every month. That's $10 every month. That's how much a year of your account.
What's the question? $10 a month?
If somebody takes $10 a month of your small business account, how much is that a year?
120.
Is that important for a small business?
Yes.
I saw people fighting over $10. Dollar. Guys, give me my dollar. If you don't give me, chopping you. Oh, why would he do that for $1?
That's his dollar.
Yeah, that's the problem. And sometimes they do chop the person, hurt them badly too, and sometimes even kill them for $1. But as far as the person's concerned, that's my dollar. You didn't want to give it to me, huh? I chop you again, chop your ma too. Whatever people do, we do some funny thing. We do some funny thing for money. It sounds a little crazy, but you'd be surprised. Okay. Just the other day in Kemp Road, a young man was arguing with another young man over something simple, and he stabbed him. The guy's now dead. He's not dying; he's dead over something simple. And the other one will go to prison, hopefully for life, over something very simple, because that's mind blowing. See? But is it really worth your life and imprisonment? Not really. So again, you have to always be assessing these things, just like in business. All right. So can everybody see this bank rec? Does your textbook say Terry Services? Would you find this bank rec in chapter 9 in your book?
No, it's in chapter 8.
That's right. Remember last week I said we'll do that this week. Exactly. Who remember? Who said that?
Beyond.
Yes, it's in chapter 8. For those of you wondering, like, I see that in chapter 9. It's in chapter 8. The example in chapter 8 is it Terry Service Station?
It's saying Kalita Services.
Are the numbers the same as what's on my screen?
Yes, yes.
It's interesting. If the numbers are the same, why do you think they changed the name?
So you could buy a new textbook.
You've
Going.
been around too long. There's an unfortunate truth to that. Of course, to give credit where credit's due, they made some other changes, they said, but not significantly enough. Changing a name, I dare say, like Owen said, is not significant enough. But what can you do? It's like insurance companies and banks, there's a little thing going on everywhere.
Try to make an extra dollar
Of who?
from us,
Who are the us again?
the poor people.
We can't escape it. We can... Oh my goodness. Yeah, the hard, poor working people. My. Okay. So if we look at this bank rec, it opens up then with the balance per bank on the end of August. Notice the heading in the bank rec, just like financial statements, you have to head it up properly. Head it up properly, head it up properly. So we open with the bank account for the month of August. So we're doing a rec for August. It's always a good idea to do bank recs monthly. If you miss a month, hurry up and try and catch up. Some people miss a whole year. Some miss years. Some don't do it at all. And some let it sit until the auditors come and force them to do it. And then everybody's panicking, have to work overtime, Saturday, Sunday, double stamps day, everything trying to update the bank reconciliations. But that's an operational issue. All right. So the balance.
What page is this?
313.
Yeah.
Okay, thank you.
There you go. All right. So what is the balance in the bank at the end of August?
$1,277.94.
Oh, you're looking at the adjusted balance. No.
Yeah. 1873.53.
The bank balance? The bank balance is $1,735.53.
Right.
As at August 31st. Okay? That's before the bank received the what?
Deposit and transit.
Deposit and transit.
Exactly. Who's preparing this bank statement? This bank reconciliation?
Whoever the
Very
clerk
service
is.
company.
The company is preparing it. So the company is looking at the bank statement that they receive a week later or a month later, right?
True, right. Without that deposit.
Yes. So they're looking at the bank statement they receive after August, and they're preparing a bank rec for August. You follow? Does everybody get that?
Yes.
Okay. Remember, just like your personal bank statement, do you get it exactly on the 31st of the month?
No.
No,
No, you get it the following month or the following year these days.
unless you have online.
Yeah, typically you get it the following month. So you're somewhere in September preparing this bank rec in the accounts department. And so you look at the bank statement, you say the bank balance as at the end of August was 1735.53. And then you say, at the end of August, I have to add this deposit in there because the bank didn't have it on the 31st. They process it after that day, correct?
Right.
You had it, but they didn't have it. So you have to add it to the bank balance. Does everybody see that?
Mm-hmm. Yes.
Okay. And then on the same bank rec, under the bank side, we have less outstanding checks. And you see all the check numbers and the amounts for a total of how much?
Total of 595.59.
Why do we subtract that from the bank balance?
Because they are the checks that haven't
They
been
coming
cleared
out.
through the bankers yet.
Correct. They haven't been cleared to the bank, but when you do the bank rec, you have to treat them as if they.
They are cleared.
Correct. They are not cleared yet, but you have to treat them as if they are cleared, so that the bank balance can be, the bank rec can be properly balanced. Now those checks might be out there for a year. So every month when you do a bank rec, they'll be in your bank rec for every month, correct?
Yes.
Yeah.
Until when? What would cause them to come off your bank rec?
When the
And
check
the
is
client go and
deposited.
cash the check.
Yeah, when they the check. That's why when you get a check, you don't hold people check until you feel like it till next year Christmas. By then it'll be
Go
still
into the
anyway.
bank. I
Yeah.
want my cash.
Not only do we want your cash, but the company wants you to cash it so they
Yeah,
can
clear it.
so they can take it off their what?
Books.
Liquid bank rec. Because if you don't cash it every month, they have to say this check is still outstanding. These checks, see what I mean?
The government have a bad case of that. They'll leave checks on your book for must be 6 months.
Who's
Then
that?
it's still dated. The government.
Oh yeah, absolutely. Okay, absolutely. So it's a big, and so for companies, the bank rec is not only controlling cash, but also controlling what? Outstanding checks. Because now if you're doing your recs correctly, you can say, we have these checks here for 3 months. Somebody needs to go and call the customer, see?
Yeah, go chase them.
You chase them now because we can't have these here indefinitely clogging up the system and throwing things out of whack. Call them and tell them it's still dated, we won't honor it. Or if it's not still dated, cash it, because if you wait until the still dated period, we will not honor it. And then that creates other problems for the company, because then they come in and say, they told me this is still there, I need a new check. And then you have all kind of big time stinky headaches. So this bank rec thing is not just movement and academia. This is real, and it has very real implications and very important in terms of the control of cash. Remember, as long as these checks are outstanding, you have to keep accounting for cash that hasn't come off your bank account yet. And if you miss something, you might think you have more money than you have and take it off. And then when you take it off, they go and cash the check, and you have enough money to cover. Does everybody see that?
Mm-hmm.
So this bank rec has a lot of reasons why it needs to be done, not just for the traditional controlling cash. That's important, but has other reasons. So after we make those adjustments to the bank statement, what is the adjusted bank balance?
Adjusted bank balance would be $1,277.94.
Absolutely. All right. Now, once we've adjusted the bank balance, to see after those transactions are adjusted in there, the real bank balance is 1277, not 1735. That's why you have to do bank rec so you can know what your real account balance should be at a point in time. Otherwise, you might mislead yourself.
Mm-hmm.
You have more money than you have. People do that all the time. They keep writing checks and not checking. And then they find out they have more checks than money they wrote. So checks returned because they don't reconcile. They don't balance the checkbook. They're too busy. I'm too busy. I said I'm too busy until some all hell breaks loose, and then suddenly everybody has time. It reminds me of people who are speeding around NASA all the time. They won't listen. Stop speeding. And it's my car, buddy. I'll speed whenever I want. And then when there's an accident, if they survive it, then all of a sudden everybody's standing waiting for who?
Police.
Police. Yeah, not police. Police. Now, if we don't, if we don't have time to slow down, how come we have time to wait for the police after we're matched up and somehow survive death? How come? Hmm. And then as soon as it's resolved and the car fixed, they speed again. Man, you just been in an accident. That was done, buddy. It's a weird thing with folks. All right. So we know what the actual adjusted balance should be in the bank statement. Now we have to take our records and reconcile our records to see if they both balance. If they don't balance, you have a problem somewhere. That's why it's part of the control. A lot of companies who don't do bank recs, they'll be shocked to know what problems they have and what they've already lost, and which they'll never recover. Hmm. So balance per bank for the books for the company is 1207. What do we add to the company books that we didn't have before we got the bank statement?
Get a note, receivable collected by the bank.
Yeah.
Interest income on note.
Yes.
Interest income.
Indeed. So during the month of August, the bank receives some money for you by wire transfer, perhaps, plus the interest of 150, and then the 1% or less interest they pay you on your bank account these days, $7.81. So these were processed to your bank account at the end of August, but you wouldn't have them until you get your statement, so you can't pass any journal entries until you do your bank rec. So you could see what came in and what they were, because you need to know that in order to what? Prepare the proper journal entry, correct?
Yes.
Okay. My. This is what we mean by accounting is very systematic and consistent, which means that some of you probably have guessed already, a lot of people are doing some very spooky accounting or none. All right. So we add in those transactions that went to the bank account at the end of the month or during the month that we discovered the following month during our bank rec, 157.81. And what do we subtract?
The overstatement of deposit for August 6th,
Okay.
collection fees, non-sufficient funds for Austin Chase, and then the service charges.
Absolutely. So these are some charges to the bank account that have to be processed in our general journal. And the only way you're going to know what they are, what the amounts and circumstances, if you get the bank statement and do a bank reconciliation. Okay. So when you do your bank rec, you find out, wait a minute, the deposit was over by $15. Anybody who read the instructions just before this example, you'll see that you were told that it's over by $15. And if you didn't do a bank rec, you wouldn't have seen it. It could have been over by how much? $3,000, right, folks?
Mm-hmm.
10,000 if you're a bigger company. See what I mean? 30,000 if you're a bigger company, and if you're not doing bank recs, you don't pick it up. And who benefits from that? Well, certainly not the bank, because the bank said it made the correction. It just means that your accounting records will be what?
Off.
Off. Yeah, either overstated or understated, depending on what the problem is. But you wouldn't know that unless you do a bank rec. So if you have a $30,000 overage, you don't do a bank rec. The bank made the correction, but you don't know because you don't do bank rec. So your accounts are out of whack by 30,000, 30 million, even depending on what it is. And then, of course, things like collection fees and charges for return checks and service charges. If you don't do a bank rec, you wouldn't know what those amounts are and how to make the journal entry. What do you think the journal entry would be for service charges?
Yeah, that's an expense.
Debit what expense?
The service, your charges, service charges, expense.
Yeah, debit service charges expense for
$6.25.
and where do you credit?
Yeah, I think so.
Your receivable?
No,
No.
You
Yeah.
credit your cash.
you credit cash. But remember, the bank took $6.25 service charge for that month. So you have to credit cash in your books so you can reduce your cash by the amount they took off your account. Does everybody see that?
Mr. Wilkinson, I have a question, right? Isn't that money expected? The bank, isn't that bank expecting that money? So why wouldn't I credit the receivable?
No, that's a service charge to your account.
The reason why you wouldn't credit receivable because
That's
it's an expense and not a credit arrangement. An expense means
Okay.
that yeah, it's already paid. The bank already took it from your account, so it's paid already. And once it's paid already, then it will not be a receivable. A receivable, remember, is what you expect to be paid. And if they take it off your account, it's paid. You just accounting for it in your records, so that your expenses will not be understated. Do you follow?
Yes.
Yeah. Good
Understood.
question. Good question. Perfect. All right. What about the not sufficient funds check? 6407. What would be the journal entry for that?
Mm-hmm.
What would be the journal entry for that?
Which one? Repeat that.
The return check.
Return check. Accounts receivable will be debited, and the cash will be credited
How would we credit cash?
because the check is canceled.
Well, I guess in a way, because it came back NSF. Now, NSF means that you will not be able to be paid for that check. So now, yes, you do have a receivable because now you have to go after the person who wrote that check. Correct?
Right.
Okay. Yes, you debit accounts receivable because you owe that check. They owe you that money. Now, the interesting part becomes, what do you credit? We know they owe you the money, so you debit accounts receivable.
Credit cash.
So they owe you money.
Yeah, you will have the credit cash because the funds that you once received for it is now being withdrawn from your account because the check wasn't honored.
Way to go. Doggone it, this crap is actually working. You guys are actually sitting down analyzing transactions already, which is the objective. It's amazing how this thing kicks in eventually. All right, so there you go. Notice all that great stuff that just went down just because we prepared a bank rec that is crucial for most organizations, if not all of them, of any type. Doesn't have to be a profit organization, it could be non-profit too, charities, whatever. They all should still be doing the same thing. Wherever cash is involved, this thing should be done so you can keep proper records and accounting and control of your cash and your transactions. And notice how we have to pick each one of the pieces from the bank rec to pass certain journal entries in order to have the correct accounting records. It's one of the reasons why accounting people can't seem to get home sometimes. There's always some crap going on in accounts. I don't know if you guys, anybody's ever worked in an accounts department or know anybody. They're always finding around stuff, working late because they're trying to balance stuff, finish bank recs, auditors are coming.
No, My accounts department is go home on time.
That's spooky. Either the controls are perfect or
Controls are perfect.
okie dokie. That sounds good. That's very unusual. Okay. Or maybe it might be like a government department, accounts department, where 5 o'clock is 5 o'clock no matter what.
No, definitely not government.
So if you're a private sector accounts department, everybody goes 5 o'clock. Somebody must be running a tight ship.
Our ship is tight.
Okay. That's not it. It doesn't just look tight.
Nope.
Okay. Just checking. Because you know some ships look ship seaworthy until when?
Something hit the roof.
Something like what? Scaller starts with S.
Well, I wouldn't say.
Not that S. But yeah, that one too. But not that one. But what I was thinking about is storm.
Okay.
The other one is not applicable once the storm begins. Then we say hit the, yeah. Okay. Now, they also took the time to introduce you to some additional information with regards to the bank rec. If you notice right under the bank rec, there's a little discussion about outstanding checks and return checks and all that. I think we're pretty much clear on where we are with that. So that little note, you should read it still. Where we talk about decrease and increases in notes receivable and what the implications are. We just talked about that. The key is recognizing them in the bank rec and making the appropriate journal entries. That's the key. Okay. All right. So now we move away a little bit from the actual control of cash. It's a lot of, as you can see, a lot of things are necessary. Remember, if you take your eyes off money, somebody's going to run with it. We don't know who or when, but there's always somebody willing to seek to run off with it in one form or another. Even some of us who have pretty good controls, people look for ways to work around the controls as well. Okay? And it's an ongoing phenomenon. This is nothing new. This is not a 21st century phenomenon. This has existed for centuries and centuries and centuries. All right. So when it's time and we get to the point now where we can no longer collect the money, we've tried everything that we could, but the time comes when we have to write off an account. That's the sad time for an organization. They don't want to write off any accounts, but eventually they do for one reason or another. Referred to as a direct charge off. Direct charge off is when we just go right to the expense account and says, we cannot collect this $3,000 from this customer. They've left and moved to Zimbabwe, and it doesn't look like we're going to get this money, so we have to write it off and bite the bullet. Okay. Now, the discussion on the write-off is about which method do we use in accounting for the write-off. Whatever method we use, at the end of the day, it's still written off. The company still loses money and all that stuff, but accounting has to have a provision for writing off bad debt. The reason why we call them bad debt is because we tried everything to collect it and we don't get it. It's not worth it to go to a factor or anybody else. We try to get it our own because the amounts are not significant, but it's important for us to get. The person has disappeared and now we need to write it off. And so in our first example under the allowance method, we are told that there was an accounts receivable with 200,000 sitting in it. At the end of the period, management decided that 12,000 of that will not be collectible. What percent of that is not collectible? What percent of the 200,000 is not collectible? I'm sure everybody has a calculator.
6%.
Okay, how did you get 6%?
About 12,000 divided by 200,000.
Absolutely. So we can see that at the end of the period, 6% of the receivables are deemed to be uncollectible by management. Notice we didn't say a supervisor made that decision, nor somebody down the line, nor a line person. It's a management decision. All write-off decisions must be made by senior management, of course, with the CFO or financial controller, whatever present, so that everybody's on the same page. Because writing off an account means that you're giving up the money you were trying to get and you are reducing your profit margins. So we have to have that under control of senior management so that nobody does any hanky pankying with the write-off process. Some senior managements write off amounts that are more than they should be. They create a larger amount because they want to show a lower profit so they can pay less taxes and all this kind of stuff. So even right down to the write-off, we find ways to corrupt the bloody system. But that's another matter. For now, we assume that that doesn't happen, that the whole world is above board, and so we'll stay in the world of academia for the moment. So this write-off amount is 12,000. What is the entry at the end of the period for this write-off at the end of the year, December? What is the entry that we make under the allowance method?
Uncollectible accounts expense debit, and
Yeah.
then allowance for uncollectible accounts credit.
Absolutely. And once we decide how much is uncollectible, that's the entry we make every year using the allowance method. So $12,000 goes to the expense side of the income statement, which means that profits will be reduced by $12,000. That's why companies don't like to write off accounts, because they lose money. Okay? And then of course the credit goes to a special account called allowance for uncollectible accounts. It's something like accumulated depreciation, but it's the accumulated depreciation account for receivables. Okay? And so you ask yourself, just like accumulated depreciation, where does that go in the balance sheet? And if you go down a little bit, you'll see that uncollectible accounts go in a very specific place in the balance sheet.
Okay,
See that? It's a deduction from what?
receivables.
Receivables.
That's deduction from receivables, and that's how we should reflect it in the balance sheet each time, so that those who are reading the balance sheet, like shareholders and others, will wonder about what the hell's going on. They see clearly that the total receivables for 200,000, the amount that management expects not to collect is 12,000, and therefore the actual book value for receivables are no longer 200,000, but rather what's the book value for receivables after we adjust it for the uncollectible?
It's
188,000.
Absolutely. As at which month? Yeah, the 31st of December. Okay? And that is how it appears on your balance sheet. Okay? Next year, the 31st of December is obviously not going to be that, because receivables go up and down. You have to make these adjustments every year. Remember we did adjusting entries?
Yes.
So for your information, this allowance method is an adjusting entry method, has to be done every year. Because every year management will look at the current receivables and say, oh, not 6% this time. I think things are better. Let's make it 4%. Okay? And then we adjust accordingly. As accountants, we just need to know how to record it. That's why we do this stuff. All right. How do we go about estimating these uncollectible accounts expenses? These are estimates that they're not going to be perfect, because we can't tell who's going to pay and how much and when. All we can do is look at the history and use some accounting methods and estimates to help us determine what might be the amount that is uncollectible. Is it a perfect science? Hell no. It's as unpredictable as our lives. Because guess what? I could be yapping about this doggone allowance account, then all of a sudden it goes quiet. Which means that I could have possibly what?
No.
Possibly what? All of a sudden I stop talking about uncollectibles. That could mean I possibly left the room,
Drop sleep,
drop sleep, or drop.
dead.
Why not? How can I tell? I don't know. And the same thing applies to receivables. We can estimate, but we don't know for sure who's going to come and who won't. The estimate is just based on our what? Historical experience. That's why it's a management decision based on certain predetermined information. It's not going to be a perfect science. Okay? So that's why we call them estimates. Okay? When your car gets mashed up, it says, I don't know how much it'll cost, I can give you an estimate though. But some people think estimates are what? The actual amount. Did you know that?
Yep, once you give them an estimate, that's it.
That's how Bahamians go. Like when we go back, they look at the estimate, 2000 actual, 2005 big fight breakout in Baintown, correct?
Mm-hmm.
Because the argument is you said 2000, and then his argument is I said estimated, because you can't be 100% sure. Now, if somebody gives you actual, in other words, if they don't say it's an estimate, then they might be stuck. But if they say this is an estimate, subject to change, then it could change. But if they say this is the amount I'll do it for, then it becomes no longer an estimate, but a what? Contract. You follow, folks?
Yes.
So if it goes over the contract, you can sue. But if it goes over the estimate, you can't sue unless you have good reason. Interesting things that come out of accounting. Okay, so what accounting estimates do we use to determine uncollectible accounts? Well, I think there are two methods that we're told, the percentage of net sales method. Let's look at that. Percentage of net sales method seems pretty straightforward to me. Anybody look at that and try to figure it out, or you just look at it and say, I don't want to figure that out. It's been a long day. What is this method showing us? Do you see 2009, 10, and 11?
That's the comparisons from the different years.
Yeah, we're taking net sales for each year and add them up. Okay, and then we look at the losses that we actually experienced for each year, 2009, 10, 11, we add them up, and then we come up with a percentage. Where do you think we got the 2% from?
That's the average.
Well, if you divide 850 for the years by 17,000, what do you get?
The 2%.
Yes. Or if you add up the percentage for each year, 1.96, etc., what do you get?
2%.
Okay. So management is simply doing this, looking at the past history and making an estimate based on that. Do you follow?
Yeah.
We do that in our relationship. If somebody comes from a history of liars, what do we estimate? That they're liars too. But that doesn't mean we're right, correct?
No.
But we just use that as a measuring stick, don't we? So these estimates are based on historical past. They're not 100%, but they give management a basis for coming up with a number that makes sense based on history. And this is a great history method, historical method to use, because anything other than that is like your gut feeling, like I think. And well, I think is a whole funny other thing. My gut. Well, gut thing is a funny thing, but going back to look at the historical records is probably always going to be a better method. So in this example, based on history, we're saying that the uncollectibles are expected to be 2% of receivables. That's all. It's no magic. And so when we do our calculations, we say 2%. What are the total receivables in the books?
Total receivables, 850,000.
That's the previous years for the current year.
The current year, 17,008.
No,
What is the current, I'm missing something.
you go back to the original data on top of the historical information. They don't tell you?
See it.
This is going to lead to an interesting question. Okay. So let me ask you something. Where did we get the $322,500 from? Did we just pull it out of our hat from somewhere?
Well, I guess that gotta be sales from somewhere.
Would it be sales or receivables? Remember, we're estimating uncollectible accounts.
Okay, maybe receivables.
Yeah, it would be receivables, 322,500. Now, minus 20, minus 25. Where did they come from? Well, remember, when you get to reading this stuff, you'll see that the estimate of 2% is multiplied by net sales. How do we get net sales by definition? Anyone? How do we get net sales? We have gross sales minus sales returns minus sales discounts. Remember that? From back in the earlier part of the semester. I don't remember that. All right. But for those of you who don't remember, in order to get net sales in business, you have to take your gross sales, just like net pay. What does net pay mean, anyone? What do we mean by net pay in the Bahamas? When you get your salary, you say net pay, $3,000.
That's after all the deductibles set.
Yes, after all deductions, then you get what's left. NIB, loan, company loan, payment loan at the bank, whatever. Take them out first. Then you get the net. You don't get the gross because you have to take deductions first. Same thing in business. When you make sales, people bring stuff back, right? Right?
Yes, right.
Yeah, whatever they bring back is a sales return. So you have to reduce your total sales by that because that has to come out now. They brought it back. And if you give any discounts, you have to reduce your sales by the discount amount too. So that's what the 20,000 and the 2,500 represent, sales returns and sales discounts. So we have to take them out first before we come up with our estimate uncollectible. So when we do that, what do we get? 2% times
300,000.
So the uncollectible for this current period becomes $6,000. And the same thing we did with the 12,000, we do with the 6,000. Do you see that entry? Does everybody see the entry?
Yes.
It's the same entry that we used for the 12,000. With the 12,000 uncollectible, management came up with that figure and gave it to the accounts department. For this one, we used the estimate. What do we call this as this estimate? What do we call this method?
That's the allowance method?
Yeah, but the allowance method is the method that we choose to use, but in terms of coming up with the estimated amount to put into the allowance account, what do we call this method?
Percentage of net sales method.
Percentage of net sales method. So what is the percentage that we came up with based on historical records?
Sales returns plus sales estimate.
Getting warm, but that's the other side. What is the actual percentage that we came up with based on the historical data for 2009, 10, and 11?
2%.
Ah,
2%. 2%. And then we multiply that 2% by net sales. How did we come up with net sales? We subtract the sales.
Sales minus sales returns, allowance, and sales.
Yeah, we subtract the sales return, and we subtract the sales discounts, so that we end up with 300,000 times 2%, which is 6,000. Welcome to arithmetic, the same stuff you hated doing in grade 7. That's why you do it, because sooner or later, no matter what your profession is, you get stuck with it somewhere. By the way, did I tell you guys that my baby graduated university yesterday?
No, congratulations.
Wow, congratulations.
Thank you. You can't see me, but I'm bowing and I have a big grin on my face. I'm finally finished with 30 years of education.
congratulations.
Thank you. Doggone it. And he's the second one. He's not the older one. Doggone it. I don't know what to do with myself now. I don't even know what I'm doing in this class today. I should be having a glass of wine or something.
You should have
Did I miss something? Did I miss something, Mr. Wilkinson? You said you got your PhD yesterday?
Hell no. My baby graduated university yesterday.
So you should have had that glass of wine from yesterday then.
I should have. I was too
Congratulations.
Was he yesterday working still? Because he was in school.
That day should have been taken off.
I guess.
And I'm still not out of the woods though, because now he has to find a job. And until he finds a job, who has to continue to pay for him? Yeah, I can't delegate that to no one. Nobody even want to hear that, especially in pandemic. Give him $500.
At the end of the tunnel.
Almost.
All mercies.
I have. He's the second one. He's not the only one. I had my oldest son that almost drive me up a wall. Then he came 6 years later. And right after one finished, the other ones, I'm like, ah.
Now you can work for you.
Oh gosh.
I hope so. I hope so. We shall see. I guess I'll have to work now to pay off all those things for school fees still, so I'm not out of the woods. What I'm saying is this parenting thing. Somebody said earlier, this parenting thing never
ends.
No. But there was some consolation. Yesterday, my baby said to me, Daddy, so many students are talking about the thousands of dollars they have in student loans. And I'm just so happy that I don't have to worry about that. Guess why you don't have to worry about it?
Because you pay it.
I'm still paying.
Oh gosh.
Everything stopped to say what? Thank you in a strange kind of way. All right. So I said, oh, I should have answered this time. I know what I'm doing. Okay. It's exciting to be finally done with 30 years of just education. And that's only education. That's not all the other crap, right, Dion?
No.
Okay. I'm just saying this for the youngsters who are just getting started.
Yeah.
Kiss my foot. Like my Grammy say, sorry for you know. What?
You're not at the end yet.
This is what you have to do. Okay, you brought like the old people used to say, correct? No answer. Okay, so you can see then the percentage of sales method tells us exactly what we do in the calculations. We use historical data to find the 2%, and then we use the net sales by taking the gross sales minus returns and discounts, multiply it, we find out what is collectible, and we make our journal entry. Every year we do that depending on the situation. Okay. Very straightforward once you understand it and once you understand the process. The beauty with accounting, as you now know, once you get it right the first time, it's a piece of cake generally in that respect. It doesn't change. The truth is also the same for if you get it wrong the first time. You will egg it up until you find out the right way every time. Okay? The other method for estimating Uncollectibles is what? Other than percentage of sales, net sales. What's the other method? The second one.
The aging method.
Yeah, the aging method. Anybody ever heard about the aging method for receivables? Am I the-
Yes.
Okay, thought I was the only one in the world who heard about the aging method for receivables. And essentially, the aging method is what? What does it mean?
The time that's the time lapse of how long the period that the funds were on the books, receivables were outstanding.
Yeah, the age of the receivables. Just like people, how long the receivables are outstanding. All right. So in the first column we have the total receivables, 88,800, broken down as follows: the amount that is not yet due, the current amounts, nobody owes you. How much is that? How much? What's the total of the amounts not yet due? The current amounts.
Not yet due is
Just look at
43,800.
43,800, and that represents what? 1% of your clients? Is that what that's saying?
Yes.
Well, we shall see. How many? What's the total of the accounts 30 days past due? 1 to 30 days.
28,500.
How many clients are in the 1 to 30 days? The clients are right there on the customer. How many of them are in 1 to 30 days?
Oh, two is showing.
Only 2?
No.
Three.
3.
How many are in 31 to 60 days?
2.
60 to 90 days.
2.
Over 90 days.
1.
Okay. So technically, who should you go after first with the biggest stick based on this aging schedule?
Over 90 days
Of course. Why?
because they're the most outstanding.
And the longer it's outstanding, the harder it'll be to get. So if you wait too long, you may never get it.
Yes.
Already over 90 days. Okay? So this aging thing is designed to help the receivables and collections department see who is where and where to put priority issues in terms of collections. Do you follow, folks? And it's also an information tool for management to help them with planning receivables, planning how to give credit, planning who to take off credit, and planning who to run down and beat to death for the money. Not beat to death. That's an expression for collecting the money. Your own money. All right. So who can tell me then where under not yet due the $438 came from? Where did that come from? The $438 on the not yet due, the allowance for uncollectible accounts for that category, where did that 438 come from? Okay, let's go to over 90 days. Where did the 1600 come from? Well, if you look right under the totals, you'll see a category called estimated percentage uncollectible. Do you see that?
Yes.
All right. Management is saying we only expect 1% of those persons to not pay, potentially. That's an estimate. That 1% works out to how much in dollars? 1% of total receivables.
438.
438.
Okay, so where did the 570 come from in the next column then?
That would be 2%.
Percent of $28,500.
Absolutely. Where did these percentages come from? They're management estimates. Remember? Are they perfect? No. They're probably estimates based on that same chart we saw earlier, historical sales.
Oh, okay, now I understand.
And you go right across the board and you can see. But these estimates are applied to the different periods in the aging process. And so at the end of the day, if we add up all the estimates dollar-wise, we come up with an allowance for collectible accounts of $4,918. Where did that come from? Total. Well, you add up all the individual columns. What do you get? If you add up the individual columns in the aging report, what do you get?
You got the 4918.
Okay, so there you go. That's the other method that is used by firms in order to help them to control and determine and estimate their uncollectibles. Remember, this process is crucial because at the end of the year, whatever you estimate it to be will be written off against your profits. And unless you've been in business to make a profit, you really don't get it in terms of how serious that is. The companies go in business for one reason, that is to make a profit. When they stop making profits, they send you home. Did you know that?
Yes, they do.
They do. Now, some of us work for such big companies where they've been profitable for decades, so we're safe and secure. Especially if we work for a government where the profit isn't even an issue. So you just do all kind of stuff as layover, don't answer the phone, be mean, be stinky, stay home, whatever. But those companies that are private companies that are in business for profit margins, when those margins start to disappear, they have to shut down, or they're going to start by sending people home, reduce staff, because payroll is always the biggest expense. That's why when things get rough, people go first, and then other things. So this thing about profitability is serious, which means the write-off process is serious. Because remember, we're looking at itsy-bitsy amounts of money here. And for a small business, it's not itsy-bitsy. But for a large business, write-off could be in the millions. And so those estimates have to be carefully thought about. Otherwise, you may write off more than you need to write off and reduce your profits more than it needs to be reduced. And sometimes management may deliberately come up with higher uncollectible expense so they could have a lower profit, pay lower taxes, when in fact the collectibles are not really that high, which is fraudulent. Cooking the books, manipulating the accounting records, unethical, and in some instances illegal. So this stuff you're looking at, in principle, if you're doing it right, it's a very serious thing. But just know, like everything else, there are people out there and organizations who seek to abuse it all the time. You may not know because you're down the line busying yourself. They have you so busy you don't know what the hell they're doing up the line. And that's how they keep it, in case you didn't notice. They don't know anything until the bubble bursts. And they say, Mother sick, I didn't know Mr. Thompson was a thief. And Mrs. Jones, she's going to my church. Mother sick. Kind of like that. You can't tell until something happens. All right. So the estimated allowance is 4,918. You see how it's done using the aging method. For those of you who might still need to be comfortable, I would say go back when we're done and just work out the numbers, see how they're set up on the aging report and that stuff. And once you go through that for about half an hour, 45 minutes, you'll be very comfortable with that process, right? And you'll wonder why you ever worried about it at all. All right. So notice, in terms of coming up with the actual amount to charge off to uncollectibles, notice what we do in this example. We are told in the first case, the adjustment of 3318 is needed to bring the balance of the allowance account to 4918. Interesting. And how do we do that? Well, we take the 4918 and we take off what? What do we deduct from the 4918? Anyone?
He said, "What we take."
Remember when we did our aging report, we said the estimated allowance is 4918, correct?
Yes.
But if you look at your text in my screen, you'll see that 4918 is adjusted by a certain amount, which we refer to as the current allowance, which is how much?
That would be the 1,600.
1,600. Where do we get that from, the current allowance? Well, we get it from the, if you look
That
right,
would be the overpass due
yeah,
for
that's,
90 days.
yeah, well, yeah, that's well, it looks like the 90 days and over, but in any event, that came from where? The allowance for uncollectible accounts account. Do you see that account?
Yeah.
Notice, what kind of account is that?
Allowance for uncollectible accounts.
Well, is it an asset, liability, or equity account? Can you guys see my screen? If you can't see it in your textbook, is the allowance for uncollectible accounts an asset, liability, or equity account?
Oh, it's an asset account.
Yeah, it's an asset account. Okay? And so as at December 31st, we're saying that the amount in the allowance account is $1,600 already posted there. Now, notice the normal balance for the allowance account is what?
That's 3,300.
Remember normal balance, not the amount.
Oh,
What's the normal balance for an allowance account? Well, where's the 1,600 sitting in the allowance account? Debit or credit?
yeah, it's on the credit.
So the normal balance for an allowance account is a
Credit,
oh, okay. What's the normal balance for a cash account?
debit,
Liability account?
credit,
Equity account?
credit,
Allowance account?
credit.
Okay. Remember, this is like learning your ABC. Nobody can learn your ABC for you. These normal balance and basic rules, you have to learn them on your own. If you don't, dog eat your lunch. That doesn't only apply to accounting. I'm sure you know that. Okay? So yeah, what is different about this allowance account? Even though it's an asset, it has a normal balance that's credit. That's just a principle in accounting. It doesn't conform to the normal asset account, which has a normal balance of a debit. The only reason why it's an asset with a credit normal balance because it offsets the receivable account. Remember that earlier?
Yes.
Okay. So the current uncollect allowance is 1,600. The estimated allowance for the new period is 4918. So in order to find out what's the exact uncollectible amount for the current period, we subtract the current allowance of 16 from last period, from the current estimate, which is 4918. And so now we see that our actual uncollectible accounts expense for the current year is 3318. Does everybody see that?
Yes, sir.
Okay. So it is that 3318 that we use to make our adjusting entry for the year. So we debit uncollectible accounts expense for 3318, and we credit the allowance account for 3318. And notice when we do the posting, when we add them together in the allowance account, we still come up with the what? Estimated amount of 4918. You see that, folks? Can you see that on my screen?
Yes, on your screen.
Okay. You should have the same thing in your text. Okay. Now, does this come to everybody automatically? No. Some of us get it right away. Say, oh, okay, take the current from the total estimate from the aging account and the difference of 3318, just make the journal entry. And then other people have to go back and let me spend a few extra minutes with this until they get it. All right. So that's the journal entry we make for the uncollectible accounts expense whenever the allowance has a credit balance. But sometimes, depending on the estimates by management, the allowance has a debit balance. If you go down a little bit, you'll see. Sometimes the allowance has a debit balance. And when the allowance has a debit balance, for whatever reason, that's for another place and time, then instead of what? Subtracting it from 4918, what do?
Do we add it?
We do. And when we add it, what does the uncollectible accounts expense become? Yeah, we add the 1600 instead of subtracting it, and so uncollectible accounts expense becomes. Well, when we add 4918 and 1600, what do we get?
$6518.
6518. And that 6518 becomes the uncollectible accounts expense for the current period. And then we go down and prepare the same journal entry. So what am I saying here? Later on, when we get deeper into uncollectibles, you'll see that when the allowance account has a credit balance, we subtract that from the estimates in the aging process that we did earlier. When it has a debit balance, we add it. Either way, whatever we come up with will be the uncollectible accounts expense for that year. And then once we know that number, we go ahead and prepare the same journal entry we always do, which is a debit to uncollectible accounts expense and a credit to the allowance account. All right. Let me ask you something, folks. Can you see my screen?
Yes.
Yes.
If you look at the allowance for uncollectible accounts, what is the total debits in that account? Amount.
1600.
1600.
Total credits?
6518.
Uh-huh.
In the allowance account?
Repeat that question again.
What then becomes the balance in the allowance account?
4918.
Debit or credit?
Credit.
Credit.
Why is it a credit?
Because the closing balance usually goes on the credit side of the allowance for uncollectible accounts.
Getting warm. But I think what you're thinking is, you remember in accounting, you always go with the balance of the account on the higher side, whether it's debit or credit. You follow?
Yeah.
Okay. So since the higher balance on the credit side, then the balance will obviously be a credit balance. If the higher balance on the debit side, then the balance will be a debit balance. Do you follow that? So based on the rule, now we have a credit balance in uncollectibles. Next year, when we do this estimate, do we add or subtract that from the estimated receivables, uncollectibles? Do we add it or subtract it? Based on what we did previously. If you look at my page, remember the 1600, when it was a credit, we subtracted it from 4918, right?
What was the question? I'm sorry.
We added.
Oh, I'm saying that 4918 that's sitting in uncollectible accounts, you can see it on my screen. That's a credit balance, correct?
Yes.
Next year, when you go to your aging profile and work out the uncollectible amounts, next year, it won't be 4918, it'll be a number. Let's say it's $7,000. What do we do with that credit and uncollectible accounts of 4918? Do we add it or subtract it from our new estimate?
Add it.
Why would we add it?
Because you add the ending and the beginning together.
Okay, getting warm. Let's go back. Look at my screen. We estimated in our aging report that the allowance for uncollectible accounts total is 4918, correct?
Correct.
Okay, then we said if the balance in the allowance account from the previous period is a credit balance, which is 1600, we add it to that figure, don't we?
Yes.
Or do we subtract it? Which one? Look at the table right there. Are we adding or subtracting the credit balance?
4918, we are taking the 1600 from that.
So when it's a credit balance and uncollectible from the previous year, we subtract it from the current, correct?
Yes.
And when it's a debit, what do? We add it to the current. Does everybody see that? So in our new estimate and balance and uncollectible of 4918, next year when we do this again, will we add or subtract this 498 from the new figure? Anyone? It's a good guess, but we actually, if it's a credit balance, we subtract it. If it's a debit balance, we add it. That's really the rule I wanted you to get to.
Oh, okay.
Yeah, once again, look at this here. You see where my mouse is? If you look at that 1600, that came from this credit. So if the uncollectible account has a credit balance, we add it to the current figure. If it has a debit balance, like here, then we subtract it. If it has a debit balance, and then we add it. So once you learn that rule, then again, it is not something that necessarily is going to come like bam. You just have to go back and make sure you understand what we add and what we subtract in any particular year. And that's where students have the most difficulty. You won't lose your life or a lot of points if you don't know it.
I'm missing something here. When will we have a debit balance?
It depends on the management estimates. Like I can't say the rule is because estimates change. For example, if you look at my screen, you will see the uncollectible account has a credit balance of 1600, yes?
Right, yes.
Okay, in that instance.
Mm-hmm.
Now, if we go down and we look at the uncollectible accounts, it's again, the 1600 is on the debit side and the new credit balance is what?
On the debit side?
No, the new credit balance.
Oh, the credit balance on the debit side, on the credit side.
Is how much?
6518.
Not 6518, but rather take the lower from that.
Oh, okay.
So now suddenly it's not 600 anymore. It becomes what?
4918.
And that would be the credit balance to use next year. But let's say something happens in management estimates, it could easily be on the other side. You see my point? So it's hard to say it's going to be a debit or credit. It just depends on the estimate and the calculation for the current period.
Okay, so each year the balance is adjusted from the previous balance.
Absolutely. Each year it's adjusted because yes, it's based on a new management estimate. Absolutely. And if you get that point, you're way ahead of the game already. All right, the rest is just the mechanics. So yes, good point, and that is exactly what happens. Okay. All right, every year. Okay, the only thing else I want you to see is when the time comes to write off an account. In this example, we said the Gomez company writes off $500 because they can't collect it. Simple entry for write-offs. We debit the allowance account for $500 and we credit what?
Accounts receivable.
Yes. T Vigo. In other words, if we can't collect anymore, we credit accounts receivable and get rid of that account because then there's no chance that we'll ever get it. This is the last resort for any organization. This is what we hate to see anytime, no matter what type of organization it is. Writing off an account where the customer gets off scot-free. Yeah, scot-free. All right. The entry is simple, but the results are devastating. All right. Okay. So we have one other area that I wanted to get into, but I won't get into that until next week. I see it's already 12 o'clock. How time flies when you're having fun. That means I'll have to revise my homework a little bit. Please go to page 329, everyone. What is the topic for that homework?
Bank reconciliation.
Okay, that's homework piece number 1. Page 329, requirements 1, 2, and 3. Page 329, requirements 1, 2, and 3. Have fun with that bank rec. Then go to page 361. What's the topic of that question?
Accounts receivable aging.
Okay, so yes, you can do that one. Requirements 1 and 2. Page 361, requirement 1 and 2. And then finally go to page 360. What is that requirement?
Methods of estimating uncollectible accounts and receivable.
That thing we just did. That would be page 360 problem. Page 360 problem. No problem indicated.
You're asking?
Yes.
Problem 1.
Problem 1.
Problem 1. Yeah, I know that's a good question. How the heck you could be asking? It's because I'm in the process. That's why I'm asking.
Requirement 1 to 4.
But you're only required to do 1 through 3.
Okay.
Page 361. What is that problem?
So wait,
P2.
360 is P1,
P1.
Requirement 1, 3.
1 to 3.
Yes.
Okay.
And then page 361. What is that problem?
That's P2, 1 and 2.
Yes, P2, requirement 1 and 2. And the bank rec is what problem?
That's P4, 1,
P4.
2, and 3.
1, 2,
320.
and that's it. All right, so that should give you the practice you need to kind of understand all the stuff we were talking about today. Remember, if you get stuck anywhere, you know how to get unstuck. Google it, ask somebody, or send me a note.
We have 4 sets of homework, right?
No?
5?
What you mean today?
Yeah.
No. Let me do that again.
The last one, 360, problem 1, 1 to 3, and problem 2, 2, 1 to 2.
That's 2 problems so far.
Yeah, yeah.
And the final one is page 329.
Yes.
2 and 3.
Sorry?
Page 329, P4,
P4.
requirement 1, 2, and 3.
Okay.
All right. If you get stuck on anything, do not stay stuck. Do not plug anything, make up anything. Please consult. And once you run out of resources, then you, please touch base with me. Let me see if I can clear it up for you so you can move on. Don't be stuck. That's the whole point. Okay? That's really what the homework exercise is about. So you can go out there and explore, dig, follow up, and then when think, man, none of this is working. I'm sending this guy a thing because I'm stuck. And that's what I want you to do. But I want you to be stuck first. Because that's what makes it interesting. Any questions? Anyone? All right, wonderful. Don't forget, next week we go right into chapter. We'll finish up the notes receivable. There's a couple important points I want you to know for your own practical experience outside of academia, for maturity of notes and that sort of thing, promissory notes and notes receivable. Very practical stuff for real life as well. So we'll spend a few minutes on that first, and then we'll go right into chapter 10. Who knows what's in chapter 10? Anybody bold enough to look forward?
Chapter 10.
I think it has long-term liability or something in that long-term asset.
Which one?
Yeah.
Long-term asset.
Long-term assets. Okay. All right. Does anybody remember what a short-term asset is? From our earlier discussion?
Short-term asset is less than
Getting warm. Keep going.
less than 90 days or 60 days or something like that.
Oh, not that one. I can see why you would say that though, because it's kind of like that. Short-term assets are also referred to as current assets. Does that help? What are current assets?
Current assets like cash.
Example, yes. But by definition, they are assets that tend to mature or materialize within
A short period of time.
within 1 year.
Yeah, less than 90.
That's a good try. No, it is considered a short period of time compared to long-term assets. Because if short-term assets mature and materialize within 1 year, then what do you think long-term assets are? Those assets whose lives extend what?
Beyond a year or so.
Beyond the normal reporting period?
Yes, beyond the normal accounting period, which is 1 year. All right, way to go. So that's what we'll be looking at next year. We're looking at those plant and equipment and buildings and machinery and all those other long-term assets that continue on for years and years and years because they are used to produce services for the company, and they tend to be the high-end products. Okay, so we'll look at them, see what they are. Maybe there's a little depreciation discussion in there as well. We'll see. Those of you who finish homework early and feel really foggy, you can start reading, and I encourage you, chapter 10, so that you can at least be familiar when the discussions begin next week. Remember, we used to have a long semester left. Suddenly next week will be week number what?
11.
11 out of 14 already. We are down the stretch, coming around the curve. And before you know it, you will be heading for the home plate, which is May the what?
29th.
Okie dokie. Remember that, keep that in mind. Keep yourself abreast. Anything that you may not remember from the last chapters we did, beginning with chapter 7, don't get rusty. Go back, have a look. I hope I gave you enough homework so that I move some of that rough spot, take away some of the anxiety because you've actually done it. Okay? And I've been going through homework. I see people I haven't seen any major missteps. Some people have gone off the reel on 1 or 2 areas, which I'm not concerned about, because 1 or 2 areas don't cause you to get 0% and not pass an examination. My concern is that you understand the core issues, and that is what I've seen so far. Anything I've seen to the contrary, I will definitely make a note of that. Okay. All right. So good luck with all that stuff and all the other challenges and issues that you have. I'll see you guys in 2 Kicks and a Shake next week, Saturday at 9 o'clock. All right. Be safe. Remember, we are in the 3rd wave, they say. So don't take anything for granted. All right. Take care, and I'll see you very shortly.
Yes.
Take care.
Same to you all.
Good afternoon, everybody.
Good day.
Hey,
Bye-bye.
take